Another leg lower on the S&P 500, 42.93. We're down about 1.3%. And if you're just tuning in on TV, on radio for our audience worldwide, we're down 5 basis points on a 10-year to 126. Shahid, this is where I want to wrap it up, and I'll make it really, really simple. If the Federal Reserve is going to start moving further towards tapering, is that bullish or bearish for Treasuries?
We think ultimately it's bearish for Treasuries, but a lot less bearish and a lot less messy, if you like, than it was in 2013. I think we need to watch real yields and break-evens. Yes, we have a little localized risk-off in equities overnight, but real yields remain extremely low. Break-evens remain relatively high in their 1 or 2 year range, even longer for break-evens. So I think financial conditions remain accommodative, and we haven't seen really major signs of tantrum or broad risk off, and neither do we expect that this year. So a relatively tantrumless taper is what we're calling for here.
Shahid, good to catch up. Shahid Lahad there, BNP Paribas head of strategy for G10 rates. Your rates this morning are lower. Yields are lower by 5 basis points on 10s to 126 on 30s. TK, you brought this up. We're down 6 basis points there. A break of 188 on a 30-year yield in America.
And I think the key thing is on 2s10 spread. The difference in yield, folks, between the 10-year and the 2-year, to get that under 1 full percentage point is another symbol. John, I'm going to go back to we've been moving awful quickly on a lot of the market, and we're just giving it up. But, John, the key thing is we're giving it up on a growth scare. And, you know, John, I think it's really important. Oh, I tripped. Oh, my God. John,
is that John, Raheem Sterling?
John, I'm sorry.
Is that Raheem Sterling?
I didn't mean to do it.
I didn't think you wanted to do football this early. Do you want to do football now?
God, it's too much.
Is that Sterling?
Oh, I just felt it was Sterling was Sterling. Let's put it that way.
I think
John,
Luke Cowell went out on Twitter yesterday and said he hadn't seen Sterling dive that much since 2016. For those of you that understand the Brexit joke, you get it. But boom.
Oh, I get. Oh,
get it? It's nice, right?
Look,
Raheem Sterling, quite easily. TK, Raheem Sterling has been the player, I think, for England in this tournament, and it's such a shame that he ended that game by doing that. The way that game was won, I think, is going to leave a bitter taste in the mouth of both the neutrals and the Danish as well.
If somebody on the Chicago Bears had done that, they would have been beaten to death up in Green Bay, right?
Yeah, I think so. I don't know what's happening on the show. We're 11 minutes into it. Tom's already doing it.
We're doing soccer talk. It's important. Come on, John. Italy, England. Who's going to win? Get to it.
Oh, Tom, you want me to choose?
Come on, let's go. Italy to England now.
Look, when it comes to nations, my loyalty is split. When it comes to football, I said this yesterday. When you grow up and your father's Italian, the blue jersey goes on and nothing else comes close.
There we go.
So when it comes to Sunday, and football exclusively, it's Forza Azzurri.
I fell down.
Coming up in the next hour, Jonathan Gull of Credit Suisse, Chief U.S. Equity Strategist from New York City this morning.
I wasn't
Your equity
even near
market
the goal.
breaking down 59 on the S&P to 42.90. A bit into the bond market, yields lower. It's a risk-off Thursday morning. Forget your easy summer trading. This summer gets interesting.
How come he gets to score on the rebound after the goalie made that great slave?
You need the appropriate tone this morning. Let's do sport a little bit later. Focus. The big bull on Wall Street, Mr. Gull of Credit Suisse, coming up a little bit later. This is Bloomberg.
With the First World News, I'm Rishka Gupta. In Haiti, police reportedly have shot and killed 4 suspects in the assassination of President Jovenel Moïse. According to the Associated Press, 2 others were arrested and 3 police officers who were being held hostage were freed. Still no word on who the assassins were. Japan may be moving closer to a no-spectator Olympics. An advisory panel has recommended approving a state of emergency in Tokyo for the entire period of the Summer Olympic Games. According to Asahi, fans would be banned from attending Olympic events in the city. Bloomberg's learned that the European Central Bank policymakers have agreed to raise their inflation goal to 2%, plus they will allow room to overshoot it when needed. That's a big change from the previous target of below, but close to 2%. And in soccer, England will play in a title match for the first time in 55 years. Harry Kane converted the rebound after his initial penalty was stopped in extra time to give England a 2-1 win over Denmark in the European Championship semi-finals at London's Wembley Stadium. The English return to Wembley Sunday to play Italy for the championship. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Okay, traders, let's place stop and profit for Japanese yen. The stop and profit we're going to place at 109.92. It will give us 2 pips. Okay, and you had to check before you placed an order to trade any pairs how much you win or lose per pip, how much money. Okay, in our case we make 100 pounds per pip, so we place stop and profit 2 pips. It means we will gain 200 pounds. Okay guys, this is as simple as that. If you would like to get this strategy, you can go to companyeye.co.uk and you can purchase strategy. You can go and you can find the webinar. We're going to provide a webinar and link available on companyeye.co.uk. So I will explain, I will tell you everything I know how to trade, how to make money on trade, and you can start trading in about 2-3 weeks time after a couple of practices. Okay guys, stay safe.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
We pay for our entire plan to make the tax system fair for all Americans. It's about time. There's a lot of work ahead of us to finish the job, but we're going to get it done. We're going to reimagine what our economy and our future could be and show the world, just as importantly, we'll show ourselves that democracy can deliver. The people of Illinois and the people of America and the world can lead again.
The President of the United States from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowitz will be back with us on Monday. Remain Bostic with us for the next couple of hours. Equity futures down 65 on the S&P 500 to 42.85. It's a breakdown by 1.5% on the S&P this morning off the back of a big bid into the Treasury market over the last couple of weeks. 125.29. Yields are down by 6 basis points, and this mood this morning has taken crude with it. We're lower there by 0.9%. TK, WTI, 71.53.
John, in the 6 o'clock hour, we've got to make clear the velocity here is to the downside. The VIX at the 19 level goes out to 20.90, so this is a market on the move.
We are sitting at session lows of the equity market and yields, I believe, at the lows of the session too, Tom. 125.29.
We'll watch that. We'll do more data checks for you today, of course, and continue this market coverage. Right now in Washington, Anne-Marie Horton joins us, our Washington correspondent. Anne-Marie, E.J. Dionne in the Washington Post has followed the moderate and the left of the Democratic Party for decades and decades, and he has a blistering note out this morning that there is no left-wing adventurism here. In New York City in the last 3 weeks, we've seen no left-wing adventurism is there. How is the left wing doing in Washington as they adventure out into the end of July?
Well, Tom, they're certainly putting pressure on the White House when it comes to the human infrastructure bill, which we saw the president really try to get a little bit more of a PR campaign in the Trump counties in the Midwest over the past week, especially yesterday, saying when he was at that college that he was there to promote and explain why we need that second package. But interesting, you also see progressives writing to the White House when it comes to things like China, about let's not go too hard on China when it comes to some things we don't agree on, because we need China on board when it comes to climate. But ever so more, as you're going to see more of these bills come to the floor, there's going to have to be the Democrats between the progressives and the moderates really come to a stance to get anything done, because they are very far apart.
Dionne talks about a 3-week window. Is the Horton window as well 3 weeks? Is that really the window that we're fitting in here to figure out where the president and the Democrats end up?
Well, what you're hearing right now, and The Hill is reporting this, that as soon as July 19th in the Senate, they want to get that hard infrastructure bill done. But as you say, 3 weeks, is that enough for it to actually get done? Because many of the progressives say, and Nancy Pelosi, the Speaker of the House, has said she will not in her chamber take up that infrastructure bill unless it's in tandem with the softer human infrastructure, the multi-trillion-dollar spending that will include tax hikes.
All right, well, let's talk about some of the more hard infrastructure, Anne-Marie. I mean, there is still a lot of talk about the transportation bill that's working its way through Congress. The idea here that, you know, some of the bridge and railroad projects, the more traditional infrastructure needs that we have in this country, that there is a little bit more support out there to actually get this done, if not necessarily support for how to pay for it.
There has to be support, though, if you're also considering the fact that we have midterms next year. It's very hard for a politician to go home to their constituents and say, I had a chance to vote for this new bridge, a fix of this road, and I decided not to do it. But it will be used for many of the Democrats as leverage. We will vote for that hard infrastructure as long as we get a little bit more when it comes to the multi-trillion-dollar human infrastructure package.
How much political capital, though, is being expended right now by the Biden administration on this, particularly when we know that he has still a relatively aggressive agenda that he wants to get done over the next 3 years?
Well, a lot of political capital is being used in terms of his aides going back and forth to the Hill. Of course, they're in recess this week, but making the phone calls and making the rounds. Also, you could see where the president has been making his trips recently. It's all been in the Midwest. It's all been into areas that are very much conservative and back the Republican campaign. And he's making his pitch as to why his goals for softer infrastructure and that human infrastructure is needed. I also would like to say that last week on Friday, when the president was talking about all the efforts they made and the goals and the progress, especially after the jobs report, when he was asked about foreign policy in Afghanistan, he didn't want to go there. He didn't want to talk about that. He said, it's a happy weekend, can't we celebrate? So it's very much focused on the domestic play right now.
Anne-Marie, let's talk about this market. 42.82 on the S&P. We're down about 68 points on the bond market. The yield right now on 10s, I see it at 125.29. We're back to levels we haven't seen since February. We're coming in about 6 basis points. Down in D.C., I've heard from Secretary Yellen. I know that she's been saying, reportedly, that apparently she supports the job that Chairman Powell is doing. What is the next step for confirming Chairman Powell for a second term? Where's that conversation at now down in Washington?
Yeah, well, there's a Bloomberg scoop out that there does seem to be support to confirm Chairman Powell, and it's pretty much the way of Washington that you would keep the chair Fed in the position. The time we didn't see it is, of course, with former President Donald Trump, but it is to maintain that independence of the Fed. Right now, we have a great scoop out on Bloomberg News talking about the fact that there are other governors. Those vacancies potentially is where the administration could start to move the dial in terms of the kind of enactment they want to see on the Fed. Things like climate and things like banking, a little bit more. It's those vacancies potentially, but there does seem to be support to keep Fed Chair Powell where he is.
Anne-Marie, thank you. It's good to catch up. Dan in Washington, our Washington correspondent. Let's pick right up on what's happening with this market this Thursday morning. We're down 66 on the S&P. We're negative about 1.5%. That's a session low. In the bond market, your yield at a session low, down 6 basis points to 125.29. It is not just a US move. You see it in the UK. You see it in Germany. Bund yields over in Germany. Your 10-year yield down 4 basis points. TK back to negative 34 basis points on a German 10-year.
I would lead with the yield analysis, John. I think that's really apt. Again, I look at the Swiss 20 as a benchmark in Europe, and it continues to deteriorate another 3 basis points and nicely into negative territory now. With that said, John, you've got to look, and we got to get a handle on where the range is when you've had a moonshot market like we've had, in particular for the NASDAQ, but even the Standard & Poor's 500, John, I've got the chart up here on the Bloomberg terminal, and I'm sorry, it's been a moonshot April, May, June, July.
Tom, I think you can sit here and say that the last couple of weeks has been a monster position squeeze, and maybe you shouldn't read too much into it, establish a narrative that you extrapolate out through the cycle. My issue with that story is, and I think the counterpoint to that, is that we are 50 basis points south of where we were at the end of the first quarter. This move is not fresh. It has been developing now, Tom, for the last several months.
Well, it has. And again, John, I go back to what the experts have told us, and there's a school out there that says that it's the when of it. We're going back to 3% growth. We're going back to potential GDP under 2% growth. But what's the when of that? And that's what we're debating in the markets this morning.
Earnings season next week. Remain have asked people repeatedly, what's important for your call on the cyclicals going into year end? Your 10-year yield or earnings? Or earnings, and they keep going with a 10-year yield and not earnings.
Absolutely, and I think the earnings is going to be the big picture, and you talk about how all these moves were sort of foreshadowed here. You saw that already in the cyclicals. You saw that in the small caps, really over the past couple of months. The underperformance of the Russell, that was your canary.
From New York City this morning, good morning. Your equity market lower, your bond market yields 125 on 10s. Alongside Tom Keene, I'm Jonathan Ferro, together with Romain Bostic. For our audience worldwide, this is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may
be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Live from New York City for our audience worldwide. Buckle up. Here's the price action. Equity futures 42.84. We declined by 1.5%. The Nasdaq down by a similar amount. You run a performance from the Russell to small caps down by 1.8%. Session lows in the equity market. Session lows for bond yield. Switch up the board. 2s, 10s, 30s shaping up as follows. Your 10-year yield, a break of 125. 124.96. We're down by about 7 basis points now. Your 30-year at 186.53. I mentioned this about 30 minutes ago. If you look at the consensus year-end forecast in our survey for a 10-year yield, right now, end of Q4 21, it's 188. Right now, your 30-year south of 188. There's some real repricing going on here, and this is one heck of a position squeeze in this bond market. But it's something else too. Switch up the board and finish on real yields. This is what we keep going back to. This is where the move has been. We are -1. There is a minus side with a 1 next to it, and that's the story in this bond market. Negative real yields, and even more so. And I'm trying to work out the best way of framing this, Tom, because people keep going back to this term, a growth shock. Well, we had a growth shock at the start of this year as well, a positive growth shock. Some aggressive repricing of what the year would hold for GDP and next year too. And now the narrative seems to be deceleration. So maybe it's the reverse growth shock that we saw earlier this year. And certainly, Tom, I think the chart captures that story quite nicely over the last 5 months.
Yeah, John, let's stay on that chart before we get to Rob Carnell. This is so important, folks. John, help me out here in that we have moved 2 basis points in the real yield from a 101 out to a 104, negative 1.04. And there in January on radio, it's real simple. The worst big negative yield was a negative 1.11, John. Is anybody we talk to, including on the real yield, see it Friday afternoon, John, has anybody framed a negative 1.12, a negative 1.15 yield? I don't think so.
I haven't heard that yet either, Tom, and I think still a lot of people in this bond market believe all this is technical, a monster position squeeze. And often what happens when you get this kind of dynamic is you get a position squeeze, you get the move in price, the narrative comes after, and people extrapolate out that narrative through the cycle. Bob Michael at JP Morgan's pushing back, and Tom, we'll work through this together because I think it's important. If you look at the consensus forecast for this year for GDP growth in America, next year and the year after, you go from a 6 handle, you go from 4, you go down to 2. Do you focus on the levels and the cumulative gains that you'll get through this economy through the next 3 years, or do you focus on the deceleration? This market at the moment is very preoccupied with deceleration. Bob Michael thinks it's cumulative gains through the next 3 years, which are important, because the cumulative gains are going to eat away at the labor market slack. And that's the dynamic that should matter for this bond market. But at the moment, Tom, that's not the dynamic that's driving this market worldwide this summer.
And that calculus, folks, is really, really important. We heard from Abby Joseph Cohen yesterday with Goldman Sachs, the idea that we would not see wage inflation as we see a re-employed America. We get lucky on Bloomberg surveillance. One thing John and I have done when we built this platform is simply to say, get us the guests. And we've done it again. Lee and I are joined at the hip, and Lee massively lucked out today by saying we need to speak to Rob Carnell of ING. They have abandoned him to Singapore, but for years known out of London for acute monetary analysis, his work with His Majesty's Treasury, and iconic work 07, 08, 09 at ING and the crust of the crisis. We're thrilled that Rob Carnell would join us this morning. John, with your expertise on the ECB, why don't you bring in Mr. Carnell?
Hey, Rob, let's start with that. The price mandate over at the ECB, you know what it used to be, still is in fact. It is below but close to 2%. That's set to change today, reportedly to 2% with a tolerance for an overshoot. Does that change anything whatsoever for this central bank in Frankfurt, Rob?
But what it does is get rid of something that I think most of us have hated for years. I mean, we never really knew what it meant. Below but close to, was it 1.9? Was it 1.8? Was 1.7 close enough? So for starters, it gets rid of that horrible, lack of certainty over what the actual mandate was. But you replace something which is close to 2 but below with effectively 2, and you can perhaps go over for a bit. And really what we're doing is we're doing what the Bank of Japan did many years ago when it moved from 1 to 2. You take a target, you shift it, you've got no more tools, you're going to miss it by a bigger margin. So it's all about credibility, and I don't necessarily think this is going to change an awful lot.
Well, Rob, their own forecast captured the credibility issue over at the ECB. On CPI, 1.9 for this year, 1.5 for next, 1.4 for the year after. Even with any interpretation of their mandate, even with that, even if it adapts, even if it changes in 25 minutes' time, whatever it is, Rob, they're still forecasting deceleration through CPI out to 1.4 and well below this target. So is their policy stance wrong, or do they just have zero credibility now to achieve it?
Well, I think you have to wonder whether these targets are actually sensible. Why 2? Why not 1.5? Why have we chosen 2? We don't seem to be able to achieve it. This year, of course, we have all the benefits of looking back at last year's terrible price level and a nice comparison. It just lifts everything. It makes it so much easier. But that won't last. We all know that. We've got a little bit of help from supply bottlenecks that's pushing things along as well a little bit. And we've had up until now a little bit of a push coming from OPEC Plus, at least giving us the sense that possibly they might do something with supply. But that's clearly not going to happen anymore. So oil's probably heading back down again. Yeah, I mean, credibility is a tough one. But, why pin your colours to a particular number? It doesn't make sense.
Rob Carnell, frame for us the German response to what we're going to hear from Madame Lagarde today. The idea of moving from Otmar Issing to Axel Weber and on to Weidmann. Is this a different Germanic response, or is it going to be the same old, same old?
I think the German response has been mellowing over the years. I mean, they've been they've very, very much been Bundesbank over the years, which has been very anti a lot of the stuff that the ECB is doing, from quantitative easing to pretty much anything at the moment. But no, that has changed. And Weidemann seems to be mellowing as well a little bit. I mean, he'll retain a sort of Germanic hawkishness throughout all of this, but I think they can see that there's some merits to pragmatism within this, given that the previous policies just simply haven't worked.
John Farrell gives us that often, too, some Germanic hawkishness. We've noticed that as well. Rob, I'm going to steal from the good people over at Rabobank this morning. They make fun of the acronyms. It's like the military. Rabobank on the ECB, is it FIT, is it FAT, is it FLAT, or is it FLOP? How big a flop is this going to be, old wise one?
Well, what they can always do is they can wrap this up in all sorts of other things as well. There's plenty of other stuff as well as the target that they'll be talking about. They'll be talking about whether or not they can bring in sort of more environmental targets. They can even talk about whether they should be thinking about a different type of inflation measure, perhaps bringing in house prices into this, which they haven't done particularly well. And talking about, do they need to think about headline rates, as they've always done in the past? And we know that these are flipped around by all sorts of supply measures that they have absolutely no control over whatsoever. So, there are other things that they can do to try and minimize the focus on the fact that what they're really doing is tinkering around the edges of something which is fairly marginal.
Rob, what about the other components of this review, the employment component, as well as this focus on climate change? How does that fold in to the inflation outlook as well?
Yeah, it's a very interesting question, this whole employment thing, because I think one of the things we noted pre-pandemic was that there was next to no relationship between the unemployment rate and what was happening to wages growth. Now, we are seeing something now. I mean, the US is giving us, the rest of the world, an interesting lesson in what's going on there, that there can actually be a relationship again. But we still don't know whether this is,
Okay, guys, let's play stop on profit for Japanese yen. And I'm going to play stop on profit at 109.89. Okay, so we'll have 5 pips in profit. Please follow my trade if you decided to copy this trade, because we need to finish, stay with me until the end. Okay, when you go on your own, please do trade on your own, and I won't have any responsibilities for your trades. But right now, if you decided to copy this trade, please do so and move your profit on 109.89. Okay?
How does the ECB, and more importantly, how does this sort of collection of countries, all that to a certain extent have different goals and to a certain extent different economies, how does the reaction, how does the outcome of this, if at all, end up different than what we're seeing in Japan and the US?
Well, it might not. I think the one thing that we're doing at the moment is we just all focus a bit more on fiscal policy. I think if you accept that a lot of monetary policy around the world has run out of pep, that it's pushing on a string, it's been doing that for many years, then you have to look at something else. And fiscal policy, it's the story that we hear about from Washington in the US all the time. It's the story that we've begun to hear about finally from Europe as well. Japan's already run that race and sort of spent everything. So I think that's where we head back to. That's what can push things along. But the money has to be spent sensibly. You can't just print it and chuck it around in a sort of willy-nilly fashion. It has to be put to useful, productive uses.
Hey, Rob, it's been way too long. It's going to catch up. Rob Carnell there,
Likewise.
ING Asia Pacific Head of Research and Chief Economist. A big focus down the ECB. We'll hear that new strategy review, the results of it, in about 20 minutes' time or so from the ECB. And we'll hear from Christine Lagarde, the ECB President, a little bit later too. Got some news, TK, coming out of the UK. The Transport Minister. Unfortunately for you, yes, for me, no. The UK to allow vaccinated residents to return without quarantine. Now, Tom, it's important here to understand the nuance. My interpretation of this is if you live in the UK and you have been vaccinated in the UK, you can travel now to both a green and amber list country. And from July 19th, you can return without quarantine. Here's the issue. If you are a UK resident and you try and come to the United States directly, you cannot come, Tom. That is the problem.
Why?
We do not have a reciprocal arrangement with the United States of America. And this is the problem right now. From July 19th, Tom, if you are vaccinated, you can travel to Europe, come home, back to the UK, great, no quarantine, all of that good stuff. So let me give you an example, my personal example. If I fly into the UK today before July 19th, they have no idea if they'd even recognize my vaccine, Tom, I would have to quarantine for a short while. I would not be able to fly back directly to the United States. I would have to find a third country and stay there for 2 weeks. So what a fantastic time to have the Transport Secretary of the United States on this morning, Tom. We'll be catching up with Secretary Buttigieg a little bit later. Why do we have no reciprocal arrangement with the Europeans, with the UK, ready to go for this summer to help out these airlines? Now, you might say it's the Delta strain. Guess what? The CDC told us, Tom, the Delta strain is becoming the dominant strain here in America too.
It is. I think it'll be very good to speak to Secretary Buttigieg about this. But, John, to me, what is so important here is you're vaccinated, you have a card. Why should you be restricted?
They haven't worked it out.
Just that simple.
Still, let's catch up with Jennifer Nutzer. We'll do that next from Johns Hopkins Center for Health Security. The senior scholar joins us next. Euro dollar 118.30. It's a firmer euro. That move at the bond market gets your attention, doesn't it? 124.96 on 10s. We're down 6-7 basis points, and your equity market is down 1.5% to 42.86 on the S&P. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. A 2-week search for survivors of that collapsed condo in South Florida has come to an end. The operation is now shifted to a recovery effort after authorities concluded there was no longer any chance of life in the rubble. Crews have recovered 54 victims, with 86 people still unaccounted for. In China, the government has signaled the economy needs more support from the central bank. Authorities hinted that the People's Bank of China could make more liquidity available to banks in order to boost lending to businesses. One way to do that, cutting the amount of money the banks have to keep in reserve. China's recovery from the pandemic has shown signs of faltering recently. And in China, Tesla has unveiled a significantly cheaper version of its locally built Model Y SUV. That's after a string of negative publicity may have hurt consumer sentiment towards the electric car-making pioneer. The so-called standard range Model Y starts at a little more than $42,000, about 20% less than the original longer range Model Y. And 36 states have sued Google, accusing the company of abusing its power over app sales through the Google Play Store. The suit, filed in San Francisco, says that Google used anti-competitive tactics to thwart competition. The company says the lawsuit gets it wrong. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We have severed the link between infection and serious disease and death. And currently there are only a 30th of the deaths that we were seeing at an equivalent position in previous waves of this pandemic.
He is taking all protections off in one go. That is reckless.
A sense of the direction of travel in the UK. That was Boris Johnson, the Prime Minister, and Keir Starmer, the UK leader of the opposition. From New York City this morning, good morning. Alongside Tom Keane, I'm Jonathan Ferro. Together with Romain Bostic this morning, here's your market. Equities down 61 to 42.88, and with it, we take a dive on Treasury yields. Yields on a 10-year. A break of 125, 124.96. We are down by 6 or 7 basis points, Tom. We just keep rolling over, and this is risk off this morning, with crude down about 1 full percentage point now to $71.50.
Watching it very carefully, I'm using the VIX as a proxy on equity out through a 2019 out to 20.69. We'll see where that goes as well. John, that new headline, let's discuss that as we bring in Jennifer Nuzzo of Johns Hopkins. United Kingdom to weigh removing quarantine on tourists from the U.S. That's a big deal.
Well, let's put it together with the previous headline, the UK to allow vaccinated residents to return without quarantine. So theoretically, if residents of the UK were allowed into the United States to travel directly from the UK, Tom, they'd be able to return and not quarantine. But there is no reciprocal arrangement. There is also no arrangement for you and I, who have been fully vaccinated, to travel to the United States directly from here and not quarantine, even when this rule comes into force. So this is what the UK is alluding to with that second headline, Tom, to weigh removing quarantine on tourists from the US and the EU. So you and I, fully vaccinated, they still don't have a plan to let us in without quarantine.
We'll talk to the Secretary of Transportation about that. He'll be listening to Jennifer Nuzzo of Johns Hopkins, the Center for Health Security, this morning. Jennifer, I'm going to cut to the chase. We have passports. Why don't we have certification of vaccination to make your life and professionals' lives easier?
Yeah, first of all, I think we should be doing everything possible to incentivize people to get vaccinated, and telling people that, you know, just because you're protected with vaccines doesn't mean it's safe. I mean, that is counter, I think, to the goals of trying to get more people vaccinated. I think what it comes down to, and I'd be interested to hear what the Secretary says about this, is how we actually establish vaccination proof. You know, it probably has to be handled at the national level. Certainly those cards that you got filled out is probably not sufficient for international travel. But, you know, the fact of the matter is, if you are vaccinated, you're protected, and we shouldn't require those people to quarantine upon arrival.
I look, Jennifer, at this moving target. When does this get fixed? John Farrell wants to know that. Maybe the Secretary of Transportation will help us. Do you see a timeline where this gets fixed rapidly, given the Delta variant?
No, and it's really tricky because, first of all, we know that there are deeply inequitable distribution of vaccines right now. So it does become a matter of international politics when basically just a handful of countries have used, you know, more than 75% of the vaccines administered worldwide. We do also worry about the penalty that places on countries that very much want to vaccinate their public but haven't been able to get vaccines. And this would be yet another, I think, setback for them. That said, on the individual level, we shouldn't be telling people that they need to quarantine after they've already been vaccinated.
Jennifer, I'm trying to figure this out, and I know you are too. The Delta variant is now quickly becoming the dominant variant here in the United States. So what is the actual scientific rationale to still have these travel restrictions here in the United States?
Well, I mean, I think this comes down to the fact that not everybody who needs to be is vaccinated, and we're still very much dealing with that. That said, I think we do have to sort through the fact that we shouldn't be disincentivizing the people who already are vaccinated and telling them that it you know, is a restriction for them. But, you know, we are going to see very likely, I mean, we're already seeing now about half of states reporting case increases. It's largely in states that have lower than average vaccination coverage, but not exclusively. And any state that has a pocket of susceptible individuals, as nearly every state does.
Okay, traders, let's move on. Let's move further. Our stop on profit, as you can see, for Japanese yen, we're moving 10 pips below, and it's going to be 109.84. We're already 1,000 pounds in profit. So please do so as well on your side. Please move your stop on profit to 109.84. For other guys who just join, well, you don't have to worry. You have plenty other opportunities to enter trade because we're day traders. Please subscribe to our website, to our streamer, and next time when we will place trade, when we start trading, you will copy our trade and you will make profit as well. This is free, no obligation. You can use your own broker. You don't have to choose us or somebody else. And you can make the same profit as we do. Depends on what money you're going to invest in security or pairs. We're trading. This profit you will be on your plate. In our case, 1 pip when we trade Japanese yen equals 100 pounds. Right now we have 10 pips in profit. It gives us 1,000 pounds in profit. Okay, guys. If you want to get a strategy, please go to company.co.uk. You can get the strategy and you can register for webinar. These days, right now, you can pay by Bitcoin if you want to. The system we already signed and it's already working. So if you keep Bitcoins, you are welcome to pay by Bitcoin or any other debit or credit cards as well for the strategy, because it's not free. Nothing free in this world. So you're welcome to get the strategy and start day trading. I'll speak to you later, guys.
One thing or another. So it was really resources rather than epidemiology that was driving the pullback in testing. I used to get weekly text messages from my health department reminding me if I had symptoms to get tested. I don't get that now. I actually had to get tested, not because I was sick, and took me a really long time to figure out where to get tested. So this is really worrisome. We had spent a year building up a testing infrastructure that's now no longer there. And as we head into potential, surge of cases in multiple areas, we may not be as ready as we need to be.
Jennifer, Sunday, we have Jennifer Nuzzo and John Farrow with us. I mean, as you look at Italy and England, I can only assume that Farrow and Nuzzo will be looking at the giant from Napoli, Di Lorenzo. Would I be right, John?
Are you trying to cause some trouble?
I am.
Tom, is that what you're trying to do?
I'm loving it.
Are you implying that with a name like Nuzzo that
Kieran
Jennifer
made this
will be
banner
supporting
up.
Italy on Sunday?
I think Kieran
Jennifer, I
nailed it
think
with
that's
this
where he's
banner.
going.
I'm a peacemaker. My mom was born in the UK. My dad's family's from Italy. So
there you go.
They're both winners in my book.
Jennifer Nuzzo, sitting on the fence a little bit there.
I think she's not committed.
From Johns Hopkins Center for Health Security senior scholar. Committed to other things. I'm fully committed to my dear Italy this Sunday, Tom.
What's their style, John, versus England, seriously?
I think that we have a lot more going for us in midfield. And I will also say that the transition from the back to the forwards is so fast. If you saw that goal just a couple of days ago, that move from the goalkeeper to Verratti, to free up the players up front, Tom, it happened so quick in just a couple of passes.
Yeah, Romain and I are watching Dodgers.
Yeah. 42.89 on the S&P. Equities down by 1.4%. Yields in 125 on
Dodgers look
10s.
good.
Freedom delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
If you have confidence in the economic outlook, equities are usually the best place to be.
I really think what the market is doing is it's reassessing how confident it is in the growth outlook.
That baton of growth acceleration is getting shifted from the U.S.
The data is good right now. The problem is that it's not good enough.
The Fed will actually end up doing what it has to do, but it may be a little bit late.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
1:25 from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Your equity market 42.95 on the S&P. Lisa is out of the building. She'll be back with us on Monday. Remain Boston, helping us get through the price action through the next couple of hours. And here is the price action right now. Just a little bounce in the equity market, still down by 1.2% on the S&P. A little bounce on a 10-year yield, but still, Tom, 125.
Yeah.
Down 6 basis points.
Let's partition this. So we got huge news flow this morning and really important voices to join us. Michael Schul coming up in moments. John, I agree. The range bound on equities is there. We have really not breached the range of the recent moonshot up. We got a little bit of stability with a VIX at 20.10. But I do agree with you, John. Fixed income should be the point of analysis.
And look at the curve, Tom. 2s, 10s, 105.
Yeah.
105, coming in 5 basis points today.
Well, it's come in 5 basis points, John, but it's 5 more basis points to an unimaginable 0.99. And it's amazing, John, how the whole inflationista thing has just been given up here. I also want to link it, John, to this huge surge we're seeing again in reverse repos, and also the idea of that pushing over out the yield curve into price up, yield down. We're not talking enough about price up.
And you mentioned the inflationistas. Here's the change at the ECB. They confirm their inflation goal to be raised to 2% from below, but close to 2% to just 2%. The new inflation goal at 2% with a symmetric approach.
Yes.
Just this tolerance, this introduction of some tolerance of allowing an overshoot that at the moment, Tom, they're struggling to generate.
You know, I haven't done a lot of work on this, but today is an awful good morning for John B. Taylor of Stanford University. And John, the key word there, as you just mentioned it, is symmetric. And that's really laced with a cultural history at the ECB and of European finance. The word symmetric is something.
Well, let's be clear. We're trimming the Bundesbank's wings here. Tom, let's be clear about that. If we had this in place 10 years ago, you wouldn't have had the Trichet hikes of 2011. Where we are now, if that's your goal, okay, do you need to change your policy because you're not forecasting inflation anywhere near to that?
Right.
2 years out, 3 years out.
And Jean-Claude Trichet, Mr. Trichet, if you're listening this morning, dial 1-800-SURVEILLANCE. We'd love to talk to you about this. But John, you look from, Maastricht Treaty and out on through Trichet, through Draghi, and to now, we can't underplay in America. This is a really historic moment for Europe.
They've added some climate change considerations to monetary policy as well. These headlines coming out from the ECB. I understand we'll hear from Christine Lagarde, the ECB president, in about 90 minutes' time. But we need to reflect on this equity market. It's a move of 53 points on the S&P. It's more than 1% lower. In the bond market, a break of 125 briefly. Right now, 10s, 125.62, in about 6 basis points. And Romain, you've got to say, this bond market right now, how we're set up on 10s, on reals, on 2s, 10s, on a curve, it makes that cyclical trade in the equity market quite difficult.
It makes it quite difficult, and we should point out the bond market really has been sort of the...
Okay, guys, as you can see, we close position on Japanese yen. We sold short at about 11 o'clock, right? 5 minutes past 11. And in 1 hour, we sold short with profit £1,000. Well done, guys. All of you who decided to trade this pair, you already made some money. If you got our strategy, you know exactly what to do. Please go further and carry on searching, looking for another good opportunity, a chance to get profit from this market. It's £1 trillion market. Don't worry, you will not affect market with your investment. And all other people, if you want to get the strategy, you need to go to company.co.uk and get the strategy. Place is still available for webinar. On 17th July, it will be Saturday. So I will spend time with you guys. It will be live webinar. I don't place recorded webinars, so you can ask any questions you want, and I will try to answer all of your questions. So 17th of July will be webinar, live webinar about this strategy and how we trade securities. We trade indices, we trade Forex, we trade many other CFDs, contract, and we make profit on daily basis. Okay, guys, stay safe, and I'll speak to you later. Let's move on. Let's see what other chances, opportunities will arise, and I'll let you know. Stay with me.
Do OIR that they're going to bring that into their inflation calculation.
In many ways, Tom, the criticism of many of these central banks is they've never really taken account for how people experience everyday prices.
Exactly.
That somehow the inflation numbers they look at are somehow divorced from the inflation that we experience. So allow me to whip through the headlines, Tom. We've got this new symmetric 2% inflation goal over the medium term of the ECB. You throw in the climate change consideration for monetary policy. That's something President Lagarde's been talking about for a while. And the headline you mentioned just briefly, recommending owner-occupied housing to be included in inflation. This new strategy will start July 22nd. That's the next ECB meeting. And I do wonder whether they have to recalibrate policy to meet these new goals. Let's bring in Michael Schell, Market Field Asset Management CEO and Portfolio Manager. And Michael, let's just start with the price action du jour. We're down 56 on the S&P. Yields are in 6 basis points to 125. What does that tell you?
Well, I think you've had a correction in cyclical equities, which goes back to May 15th. There's a lot of things, which are down 10, 15% since then. It's not tragic in terms of a year-to-date performance. Growth has been able to ignore that for most of that time. And, I think that sort of gap between growth and cyclicality has got too far. And that portion of the S&P probably has to come down now. I think the bond market, again, yields have been correcting, bond prices have been breaking out. For several weeks, there were obvious technical levels that had to hold in order for this to stop. 140 in the 10-year and the 200-day and the 30-year both got breached. And if when you see an obvious technical level overwhelmed, you'll get follow through like this.
Michael, you've got a great synthesis here. Let's do the cliche of the glass half full. Is the glass half growthy now worldwide, or do you really suggest some form of growth slowdown, the fear of the stagflation the gloom crew talks about?
I think it depends on what you're looking at. I do think there's a threat to the sort of pure reopening trade, that some of those sort of COVID-sensitive sectors have a harder summer than people were hoping for. But if you're looking at sort of what I would call heavy growth, again, the durable goods economy, industrial activity, all of that kind of stuff, looks to have multi-quarter momentum behind it. And you will get periods of setbacks in equity markets because, that's simply what they do. But I still think we're in the middle innings for that portion of the global economy.
When you look at the price action, it doesn't appear, Michael, at least on the surface, that anyone is really necessarily pulling cash out of the market in any sort of meaningful way here. If that is the case, if that is true, if that is what we're seeing here, what does that tell you here about the potential for the market to actually rebound?
I think we'll know a lot in a few hours' time. I mean, I think it depends how the market's going down. If it's the stuff which is overshot coming back, I think that's really actually quite healthy. What you'd want to see is some of the cyclical sectors which have lost ground, start to show a little bit of resilience. One thing we have seen in the last couple of days is that gold, is showing signs of stabilizing, and that might be important because gold has really been a pretty poor place to be since the late summer.
Michael, you know the story, though. This debate was about the cyclicals not just winning the year, but winning the cycle, potentially. That the banks would outperform somehow big tech, that this cycle was going to be different. The trajectory of this recovery would be different, not just through this year, but through the next several years in a way that we didn't see that in the previous cycle. Therefore, your investment strategy needs to change. Is that still the case? Has anything you've seen change that?
No, I don't think a 6-week period like this would change anything. I'm not particularly dogmatic about banks versus technology. To me, cyclicality is more commodities, industrials, shipping, logistics, all of that kind of stuff. And as I say, the demand-supply imbalance, still looks very attractive as far as the corporate sector is concerned. But this stuff isn't straightforward and doesn't move in a linear way. And you talked about the euro crisis a few minutes ago. People thought that was the end of the 2009 bull market at the time.
Yeah, and how wrong they were on so many levels. Michael, it's good to see you. Michael Schauer, Market Field Asset Management CEO. On a fascinating session this morning, once again. We're down by 56 on the S&P to about 42.94. We've got a break of 4,300. A break of 125 earlier on 10s. Right now, Tom, 125.62. We come in 6 basis points.
Yeah, there's a little bit of calmness here within the very difficult morning. Dan Elper just put out an absolutely brilliant tweet.
What did he say?
Of course, the age of oversupply. He says, look, we've run out of bonds. We've got overnight repos, moonshot up. Zoltan's done a great job on that, and many others, Ira Jersey at Bloomberg as well. But he says, we've run out of bonds. John Templeton personally told me, John, when I could shave once a week, he said, Tom, there will be a shortage of bonds.
That wasn't the story.
And that's where we were.
When we came into this year, and we were talking about Washington, D.C. and the free spending
my word,
Democrats.
The issuance of bonds were all going to die.
The deficit in the bond market. And here we are, Tom, at 125. Now, arguably, some people think part of peak everything is peak fiscal as well. That the enthusiasm to do the free spending many people thought would happen, some people feared would happen, hasn't developed in the way they thought.
I mean, in Romaine, it's real simple. We miss Lisa so much. We've got to talk about the pendulum of a bond glut, because that's what we were going to have.
Well, yeah, that was the narrative. But look, this is also sort of a bet, I think, on the idea of duration and the idea here that if the Fed does stay put and stays put for a little bit longer here, then I guess in some sort of perverted sense here, 125 maybe looks attractive.
Is it because people think the Fed will stay put, or because people think maybe they've got a bit of an itch here? Remain.
Yeah.
That the risk management, the balance of risk around inflation has shifted, and you saw that yesterday in the minutes.
Absolutely. You saw that in the minutes, and I think you're seeing that in some of the money flows as well.
Romaine Bostic, Tom Keene, Jonathan Ferro, counting you down to the opening
symmetric.
A couple of hours away. Coming up next, in the next hour, we'll catch up with Pete Buttigieg. What a timely conversation.
I'm going to ground.
With the Transportation Secretary from New York City. We're down 57 on the S&P to 42.92. Your bond market is bid. Your yields are lower, 125 on 10s, on radio, on TV. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. In Haiti, police reportedly have shot and killed 4 suspects in the assassination of President Jovenel Moïse. According to the Associated Press, 2 others were arrested and 3 police officers who were being held hostage were freed. Still no word on who the assassins were. European Central Bank policymakers have confirmed that they are raising their inflation goal to 2%. They also recommended that owner-occupied housing be included in inflation statistics. Meanwhile, climate change will be considered in the ECB's monetary policy. Japan may be closer to a no-spectator Olympics. An advisory panel has recommended approving a state of emergency in Tokyo for the entire period of the Summer Olympic Games. According to Asahi, fans would be banned from attending Olympic events in the city. And the European Union has imposed fines totaling $1 billion for Volkswagen and BMW. Regulators say the two companies colluded to delay the rollout of emissions cleaning technology. Mercedes parent Daimler avoided a fine for being the first to tell the EU about the cartel. And in soccer, England will play in a title match for the first time in 55 years. Harry Kane converted the rebound after his initial penalty was stopped in extra time to give England a 2-1 win over Denmark in the European Championship semi-finals at London's Wembley Stadium. The English return to Wembley Sunday to play Italy for the championship. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Inflation, I think, is going to be less temporary than they think it is. It's true that there is a supply shock, which is temporary. But the real reality here is just demand is really jumped a lot because of a very expansionary fiscal policy and pent-up demand because most Americans are financially much better off than they were before the pandemic, and they haven't been able to spend.
That was Rick Mishkin there, the Columbia University Graduate School of Business professor from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Together with Romain Bostic, Lisa Abramowitz will be back with us on Monday. Here's the good news for the equity market bulls. We're off the lows. Here's the bad news. We're down 55. We're negative 1.26%. And the bid is back in this bond market again today. We're down by 5 or 6 basis points. Off the lows as well on a 10-year yield. We did have a little look at 124. 125.96 is where we are at the moment, Tom. We come in 5-6 basis points.
Yeah, watching it very carefully here, both in bonds and equities as well. I should point out oil giving us some stability and, frankly, less demand, more of a less growth tone. $73 on Brent crude. Jet Fitzpatrick with us now from Bloomberg Government. John, I know you want to talk about some of the debt ceiling dynamics. Jack, I do have to talk about 1915. There was an assassination in Haiti before World War I, or the U.S. involvement in World War I, I should say, and we sent the troops in to Haiti at 689 miles from Miami to Haiti. Haiti is not Cuba, but Haiti is close. Are we going to send the troops in again?
I would not expect that. There's been not necessarily a forceful response just yet, as we're still watching everything play out in Haiti. But we're watching a Biden administration that obviously is trying to be less interventionist than in recent years. So really, to be honest, it's been a fairly quiet response so far. Obviously, still as this the story is playing out, but a fairly quiet response so far from the Biden administration and even from lawmakers in Congress.
It is early days, frankly, for a State Department tone. Is there a State Department tone on our domestic sphere, almost a Biden doctrine on the Caribbean, Central America, and South America?
In the Americas, I'm not sure you could say they have set a very clear tone. I think in the early days of this administration, the Biden administration has looked to cast its eyes over to Asia, probably more than anything else, and largely has attempted to shift from the Middle East to Asia. Obviously, you can't focus solely on what you want to focus on in foreign policy, but I think based on they're focused on Asia and the things that have popped up elsewhere, issues with Russia, issues in the Middle East with Israel and Palestine, we really haven't gotten a distinct tone or that much of a vocal focus from the Biden administration on sort of setting the agenda in the Americas.
Jack, we've got to sort out the agenda here in the United States of America, the domestic story. What's happening with the big debt ceiling debate?
Yeah, so technically their deadline would be August 1st. There is now an expectation that they can kick that probably past September 30th. That is sort of the guidance that lawmakers are relying on, according to the House Budget Chairman, John Yarmuth. If they can do that and the Treasury can use extraordinary measures to get them into October at least, that could be tied up with negotiations to fund the government. Secretary Yellen seems to have at least privately pulled back on some of her very urgent words about trying to get this done early. And there were some conversations between her and lawmakers, after which lawmakers came out and said this is going to wait until probably October, if not a little bit later. And they're hoping that there's nothing unexpected that comes up with the pace of spending. But there is an expectation that they're going to try to get something bipartisan done that could be locked into and tied up with government funding ongoing debates that would come up starting in September rather than anything really urgent now.
Jack, just quickly, you mentioned it, so let's go there briefly. Secretary Yellen used some pretty dramatic words to describe the urgency of needing to settle this. A highly experienced policymaker down in Washington, obviously on the monetary policy side and now in the Treasury. Jack, what was she doing?
She may have gotten a little bit out over her skis. Very shortly after she used the strong words saying really Congress should, if not needs to, should address this before August, she met with some lawmakers on Ways and Means afterwards, would not take questions on it, and a number of lawmakers later followed up saying that she had claimed her words were misconstrued and that she wasn't trying to pressure them too much too fast, and that lawmakers instead were going to wait on this and believe they had enough time, so that this was more of an October issue than a now issue. And she hasn't pushed back on that new interpretation. So it's a much less aggressive stance right now than what she vocalized in a committee hearing a couple weeks ago.
Yeah, real quickly here, Jack, the issue going on right now with China, of course, all the drama surrounding the DD listing. We've seen a couple pieces of legislation be pushed forward here yesterday, including from Tom Malinowski, and there were some pretty strong comments out of Marsha Blackburn of Tennessee here. Any real impetus here in Congress right now for some sort of formal response to what's been going on in China?
From Congress on a formal response, we're still in the early stages. Obviously, Congress is motivated to get going on bills relating to China, economic competition with China. That lately has been more on the R&D side. In terms of responding to the latest news, bill introductions, statements from lawmakers, that's what we're watching for. But in terms of something really moving forward, we are still sort of in the early stages.
Hey, Jack, good to catch up. Jack Fitzpatrick there, Bloomberg government reporter, and the team at Bloomberg News reporting in the last 24 hours that the Chinese firm LinkDoc is said to have halted its US IPO plan to remain not exactly surprising. And Tom, I think, remain right to bring this up. We had a Chinese company come to US capital markets, tap those markets for billions of dollars, and then the Chinese Communist Party gave them a good slap around the head and clamped down on the company. Now, you get to decide your interpretation. I won't give you mine.
Well,
either this was about clamping down on US investors and firing a warning shot here, or it was a warning shot for the Chinese company itself.
John, I'll bring it one over, and I'm not editorializing here. I'm just wondering, and of course, this, John, is my plaque at the M-Bar at the Mandarin in Hong Kong. John, what does this mean for our banks in Hong Kong? Seriously. What does it mean for our banking relationships in Hong Kong?
What does it mean for the banks also that are listing these companies here in the United States, Romain?
Yeah, and I think the legislation that really, the one that Malinowski is pushing, I think this is sort of maybe a sign of what's to come here. I think Congress is going to try to take some sort of formal step here. Whether it sticks, it'll remains to be seen.
Romain Bostic, Tom Keene, Jonathan Ferro, counting you down to the opening bell, 2 hours away. In about 65 minutes also, you'll have jobless claims in America, some important economic data coming a little bit later this morning. 42.95, we're down 54. We're off the lows, still negative 1.24% on the S&P. Yields are in 5 basis points to 126.79.
Denmark should have won.
And euro dollars at 118.42. On radio, on TV, this is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Live from New York City on TV and radio for our audience worldwide. Good morning. Here's the price action this Thursday morning. 42.95 on the S&P. It's a breakdown on the S&P by 1.25%. Outside of that on the Russell, that's where your underperformance is. We're off by 1.75% on the small caps. On a NASDAQ, down by 1.26%. And it's the same old debate. What do you want to own? Growth, value, the cyclicals, the big tech, all of that good stuff. And it's all largely off the back of what's happening here. Switch up the board and get to the bond market. Your nominal 2s, 10s and 30s, your 10-year yield, 127.45. We bounce off the lows of the session. We're down about 4 basis points or so. On a 30-year at 188, a couple of important things to think about here. 188 is your year-end median forecast, not for the 30-year, for the 10-year. This is a market caught off guard. It's a squeeze. And when you get a squeeze, you start to get some people building some narratives, including myself, and then those narratives get to extrapolate out through the whole cycle, and you wonder whether that's the right thing to do this morning. Your 10-year yield, 127, so where are we? About 40 basis points south, 50 basis points south of where we were at the end of March on a nominal 10-year yield. The 2s, 10s curve is just about holding its neck above water here, above 100 basis points. We were pushing 160 at the end of March, and my point here is this isn't a fresh move. It's not new. It's been developing now for the last several months. But here's the chart I want to show you. The most important charts sometimes are the most simple charts. You can take a picture of real yields, of nominal yields, and we'll be ducking and diving all over the place. But if you take a nice clean picture of the S&P 500 over the last 12 months, Tom, the picture's pretty clear, isn't it? It's up and to the right.
Oh, really?
Regardless of what's happening in the bond market, it's just up and to the right. And it keeps on going.
John, it's hugely important. And, I don't have it ready now, but you put up the banner of the 12-month return on the equity markets. And, John, I'm really glad you put the persistency here of the Standard & Poor's 500. We're doing the nuances of NASDAQ this and that. And, Romaine does the individual stocks. But, John, I'm sorry. It's a bull market. That's what it is.
And the reason I do this, Tom, is because we've talked so much about guessing where the bond market will be.
Yeah, exactly.
And what it will mean for the equity market and individual components of it. We've had a lot of people come on programs like this one through the last year and talk about active management is going to be so important this year. Look at the S&P up and to the right over the last 12 months.
I think it had a lot to do with window dressing June 30. I'll be honest, I think they're behind, and the moonshot on Amazon and the rest of it, I think that had a lot to do with it.
Something to think about. We'll catch up with the biggest bull on Wall Street, Jonathan Gulliver, Credit Suisse, in just a moment, looking for 4,600 on the S&P. Before we get there, some stocks to look at. Morning, Romaine.
Hey, good morning, John. Yeah, obviously this is a bull market. The latest leg of that bull market was driven, of course, by those big cap tech stocks. And I say was because at least for today, there's a little bit of a breakdown there. Now, whether this is a longer-term breakdown or simply a little bit of profit taking is going to take a few more days, maybe in a few more weeks to find out. But right now you're seeing Apple down a couple percentage points here in the pre-market. Similar story for Amazon and Microsoft. All three of those names closed at record highs yesterday. All three of those names are up double-digit percentages just over the past 5 or 6 weeks alone. So when we talk about this narrative of a backtrack away, I guess, from the reflation trade, well, I guess there were signals of that already. The fact that these three names had been embraced, you flip up the board, three names that hadn't really been embraced for the last 5 or 6 weeks, it was a lot of those travel stocks, the Carnival Corps, of course, the United Airlines and the other airline stocks, and a lot of those material companies, including Freeport-McMoRan. Those names, they've been down by double-digit percentages since the beginning of June here. Carnival down about 4% here in the pre-market, United Airlines down about 3%, and Freeport-McMoRan down more than 3% here in the pre-market here. So this is a little bit of a rotation going on, a little bit of a push and pull amongst investors who are maybe trying to decide whether this bull market can continue, but more importantly, if it does continue, where the leadership is going to be, guys.
Romain, thanks so much. Hugely valuable there. Look for Romain this afternoon as well. Right now, we've been just thrilled with what our booking team has done to bring in equity voices. Liz Ann Saunders with us, Ed Yardeni yesterday, Abby Joseph Cohen, and now we continue with Jonathan Golub of Credit Suisse. His calls early in the year were distinct, and they were different. We get an update this morning. John Golub, can you give me S&P 5000 this morning? I got to make some news.
I don't know if I can give you S&P 5000, but the things that have made me optimistic about the market are still in place. And more than anything else, it's earnings. We're going to start to hear, I think it's next Tuesday from JP Morgan and the big banks. The consensus view is that we'll have 61% upside in earnings versus a year ago. Our read is that that number is going to be 75%, and if we're wrong, we're too low.
Okay, so this is really important, folks. We're going to stop the show right now because this is critical. We're going to get to that earnings call. We all know consensus is different now than it's ever been. John Golub, can you make a shift to secular growth based off those earnings, or do you got to hide in a hole because the world's going to come to an end 18 months later?
No, I mean, I don't think that this story is changed as much as the headlines are. I think there's two battles. The fundamentals are unbelievably strong. This is going to be the strongest GDP quarter we've seen. The economic data is generally very good and continues to improve. Value is cheaper than growth. Cyclical, old economy, boring companies are delivering stronger growth. These are companies like mining companies, things like that. Now, if you look at what happens, however, when interest rates fall, the market favors growth stocks in a falling interest rate environment. This is all the market is great. The question is just, as you guys have mentioned, where's the leadership? What wins within the market? Because the market still wants to go up and to the right.
John, why can't I just buy the market, buy the S&P? Why do I have to get into the detail? Why is it all about active management this year when quite clearly you're doing okay just holding the S&P 500?
John, I don't think that's a terrible call. If you are a hedge fund that's watching this show, you don't have that option. You have to try to figure out how you're going to outsmart the market. And for them, I think the story is between now and the end of the year, value wins, cyclicals win, and that there will be a time for growth, but it's not right now. If you're a long-term investor, whether you buy the broad market or whether you buy these tech themes that Romain highlighted, we're selling off. Long-term, it's a growth story. So if you're an individual, you could ride the wave that way. If you're a hedge fund, you got to play this more tactically.
Let's put a bow on it then. Let's make the big point. What's more important here, the earnings or where the 10-year yield is? Because, John, I've asked that question repeatedly in the last 24 hours, and they've said the latter, not the former. I can sense that you think it's very much about the former. It's about where the earnings go.
Listen, if you're looking at the overall market, the whole thing is an earnings story. As a matter of fact, for all those that are talking about how expensive the market is because stock prices are up, there's been no increase in valuations and PE multiples in a year. The stock market is moving only with the earnings story. If you're looking at this in terms of within the market, growth versus value, tech versus financials, then it's all about interest rate. But the market, it's an earnings story, full stop.
But put into perspective here, Jonathan, how resilient the earnings picture has been. I mean, there's been obviously a lot of disruptions. There's been a lot of talk about supply chains. There's been a lot of talk about wage growth. The idea here that all these sort of various factors would somehow upend the earnings picture for some of these companies. And overall, at least on an aggregate basis, it's held up pretty well.
Yeah, you know, Romain, you make a good point here. First of all, the smartest question I recently got was not what is this year's earnings versus last year, because we know last year was a beaten up number. What does it look like compared to 2 years ago? Are we above prior peaks? The expectations consensus is that we'll be about 9% above where we were 2 years ago. Our estimate is that we'll be 19% above by the time all the reports are in for this quarter. So that's really amazing. We still have all this disruption. We can't get the things that we want delivered at all. The unemployment rate is high, and yet we're talking by the end of this quarter, we'll probably have 20% stronger earnings growth than we did before the pandemic started.
I mean, Romain Golub talks about the smart question he got 4 years ago there. No, the best question Golub got, Romain, was John Farrell's question a moment ago. Are we supposed to be worried about earnings or the 10-year yield? That's the money question.
Yeah, I mean, that is the money question. And look, I mean, obviously, Jonathan, you know, people are going to obsess over this. They're going to obsess over 125 or whatever we are now. They're going to obsess over whether we're headed towards 1% or whether we're headed back up towards 2% here. I mean, provide some sort of soothing advice here. What do you tell people who are maybe staying up late at night, staring at their screens the way John and Tom do on this 10-year yield?
Right.
Yeah.
Well, you know, first of all, if you take a look, I made this comment, I guess probably about 8 weeks ago, when we were about 150, which means that we were an equal chance that we would get 150 on the 10-year, equal chance that we would get to 1% or 2%. And I was really vocal that if you end the year closer to 1, the market is going to be weaker than if you end the year closer to 2. The market likes higher rates, and people just don't want to buy into that idea. Higher rates are an indication that demand for capital is rising. It's a sign that the economy is strong. The reason the market is selling off today is because people are asking the question, what the heck is wrong that interest rates are falling when this economy is supposed to be so good? So, you know, we want higher interest rates. I would argue that if the interest rates continue to move towards 1, that my optimism, I still think the market will be higher, then I'll be proven to be too optimistic. If interest rates back up towards 1.5, 1.75, the market is on fire.
To be clear here, John, we get a move down to 1, and that 4,600 price target of yours is in question.
I think that the likelihood of me hitting that number is lower. And on the other hand, if we get towards 1.75 or 2%, I may be too light on my number. You are right. There's no question. The sentiment of the market right now is all tied to what's been going on with the 10-year. And if last earnings season is similar to this one, the market's going to care. If interest rates continue to fall apart, the market there's a chance it just ignores the earnings. I don't think that'll be the case, though.
Jonathan Golub of Credit Suisse, Chief Equity Strategist. John,
did he give us a 5,000 target? I think
he didn't, Tom. He didn't. He said that if yields were higher, he might reevaluate higher. He said if yields came lower, he might reevaluate. Or there is less chance of hitting that 4,600. I think you're being a little bit kind, Tom, about whether there was a move there or not. I don't think there was a move there. 4,600 on the S&P as year-end over at Credit Suisse.
Do you notice the difference in the show, John? I mean, Romain is so much more optimistic.
Just a little bit more, yeah, you know. I don't think Romain's got the prize that he wants to be validated by a sell-off.
No,
Tom.
you know,
we put it that way.
It's the pendulum of soothing advice.
The pendulum of soothing advice.
Looking for soothing advice from our guest this morning. Romain Bostic in for Lisa Abramowitz. Your equity market, 42.91. It's off the lows. Your bond market, yields are off the lows too, but still...
Can we get all three of us to wear bow ties one day?
We're down 3 or 4 basis
great
points.
On radio.
We have a rule on this show, Tom. 70 plus for the bow ties. 70 and under for the ties.
Has John ever worn a bow tie?
And the older you get, the fatter the tie gets as well.
Oh, also older you get, the fatter the talent gets. Thank you.
Coming up next, in the next hour, Eric Adams, the Democratic nominee for New York City Mayor. An important conversation in the next hour together with Secretary Buttigieg. We'll do that in about 30 minutes' time. From New York, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. A 2-week search for survivors of that collapsed condo in South Florida has come to an end. The operation has now shifted to a recovery effort after authorities concluded there were no longer any chance of life in the rubble. Crews have recovered 54 victims, with 86 people still unaccounted for. Good news for some British travellers. Those who have been fully vaccinated will no longer need to isolate for 10 days when they return home from moderate-risk countries. Instead, they'll be told to take COVID tests after arrival. The UK's relaxed rules will offer a boost to the ailing travelling industry. And in China, the government signaled the economy needs more support from the central bank. Authorities hinted that the People's Bank of China could make more liquidity available to banks in order to boost lending to businesses. And one way to do that would be cutting the amount of money the banks have to keep in reserve. China's recovery from the pandemic has shown signs of faltering recently. 36 states have sued Google, accusing the company of abusing its power over app sales through the Google Play Store. The suit filed in San Francisco says that Google used anti-competitive tactics to thwart competition. The company says that the lawsuit gets it wrong. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Isn't it, just how sensitive the markets are to any commentary about trade? We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
imagine about September, October, in Southeast Asia, we're going to start seeing travel resume, firstly with domestic and then international. We've already been given word that those who are double vaccinated will be allowed in. And you see the reopening in Thailand. They've set very clear dates. So time is coming.
That was Tony Fernandez, AirAsia Group CEO from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro, together with Romain Vostik. Lisa Abramus will be back with us on Monday. 42.87 on the S&P. We recover just a little bit with the emphasis on little bit. We're down 62 still. We're negative 1.44% on the S&P. Yields coming back up just a little bit as well. Once again, the emphasis on a little bit. We're still at 127.78. Yields are lower, Tom, by 3 or 4 basis points.
Are we going to have green on the screen by the time Romain does the show this afternoon?
At this rate, I think we'll have green on the screen by tomorrow or something, Tom.
I don't know.
Just at this rate. I mean, that's not me making an observational judgment about the future.
Back.
Just 42.87 on the S&P is where we are right now.
And now it's time for
the
the public service part of the program. And just to get to it, because we got so much to talk about this morning, David Wilson is going to straighten you and me out on all this marketing blather of the indices. The FANG Plus index, in my opinion, is a disgrace. For starters, it doesn't have Microsoft. It's got a bunch of other noise in it, and it's basically, David Wilson, it's a manufactured index of marketing. Am I wrong?
Well, I mean, it's hard to argue against that. You bear in mind what's been going on with the FANG stocks. We've seen Facebook at a record this week. We've seen Amazon.com at a record yesterday. Google's owner, Alphabet, also at a record yesterday. Now, Netflix has kind of been left behind a bit, but, it's a relatively small company compared with the other three. So, with these FANG stocks setting records, you would expect the New York Stock Exchange's FANG Plus index to set a record as well, and it just hasn't happened. It's been stuck below a high in February, and there's a very good reason for it. There are 10 companies in this FANG Plus index, and 2 of them are Chinese. Alibaba Group Holding, the online retailer, and Baidu, the internet search company. And those stocks have been caught in, the Chinese government's crackdown on companies based in, China and trading overseas.
You are expert at this. How do you treat indices that are literally a marketing plan of somebody? We got to do an index so we can get out there and be visible with Romain Vostik on the close. So they invent an index, right?
Well, and then you can have futures and options on that index. That's definitely a part of the mix as well. I mean, you just have to bear in mind that, the indexes of today are not the indexes of, 4 or 5 decades ago, because so much of it is tied into trading in one way or the other. So you have this FANG Plus index, you have futures on the index, and so on. And, you don't want to just put it in 4 stocks, because if you did, I mean, it would be too concentrated. Of course, the thing is that if you were to track an equal weight index of those FANG stocks, and that's part of the chart, you'd see that they were up quite a bit since February, when that FANG Plus index peaked, actually about 12% over that 5 or 6 month span.
Yeah, I think you need to remind Tom, Dave, that, the Dow Jones Industrial Average was a marketing gimmick. A lot of the indexes we have out there were basically marketing gimmicks to sell newsletters and whatever else people were reading back in the 1800s, early 1900s or whatever. So I get it. And to his point, though, Dave, and when we talk about how we measure effectively what is big cap tech, because that is effectively what the NYSE FANG Plus index was supposed to be here. Is there a general argument now that maybe we need to move on from it? Maybe there's something better out there that Tom is sitting on that he hasn't quite revealed to us yet that would better capture the essence of what this is supposed to be?
Well, it's entirely possible. I mean, these days, you can't keep Microsoft out of the equation. You think about the $1 trillion club, it's part of it, along with Apple, Amazon, Alphabet, and now Facebook. So, I mean, those 5 companies right there, if you don't have them all in an index somewhere, you're not really capturing what's happening. And you can, make the argument about Tesla as well, even though it's a car company. I mean, there's a lot of focus on, technology within its business. So
yeah, you're reaching.
Yeah, Dow futures down about 500 points right now.
David Wilson, thank you so much. Greatly appreciate it.
Yeah, I did. I did. I like to poke the bear every now and then.
Romain, thank you. Okay. Equity futures down 61 on the S&P, just to make up for that lapse in concentration on this
This
program.
will be my last appearance on the show.
You'll be back tomorrow, no doubt. You wish. Romain Bosty doesn't want to get up this early. That's the secret in all of this. You wish, Romain.
John,
right
I get going with the marketing. I'm sorry. I get it.
I'm with you. I
Romain's
understand.
correct. The Dow was a marketing plan a million years ago. I get it. But come on. Is Tesla a FANG stock?
Clearly no.
No, it's F-A-N-G.
G is that's the giveaway. But if you want to be concentrated in some of the big growth names, which essentially is what that particular index has become, then maybe it makes sense, Tom. I'm not here to defend or criticize it.
Yeah.
I'm sure someone's allocated to an ETF passively that tracks it.
Yeah, I mean, I look at Keefe Bruyette Bank Index, and there's a lot of work that went into that. The Bloomberg Commodity Index is a really, really smart set of mathematics. The financial, whatever it is, standard deviation index we got off the IMF, that's really smart mathematics. Most of this is marketing stuff. I'm sorry.
Yep, as is a lot of the commentary on this program, Tom. It's marketing
No
stuff.
way.
I mean, when people come on here and talk about active management, what do you think that's about? We caught up with Jonathan Golub, Credit Suisse, 20 minutes ago, and we just asked him the question directly. Given what this market's been up to, you could take a chart of a 10-year yield, take a chart of break-evens, take a chart of real yield, spend all your time going through it all, chop, 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 ducking and diving. Then you look at the S&P 500, and we showed the chart, and we can show it again. And for our listeners on radio, there's no secret to this. Lower left, top right, up and to the right, aggressively over the last 12 months, and it's a pretty straight line, Tom.
Yeah, Justin Sharp Banner emails in. Justin, thank you so much for watching this morning. And he says, you throw Tesla into the index, and I'm sorry, it's the F-Tang index.
Oh,
it
right.
works perfectly.
Okay.
There we go.
There we go. Maybe that's your future, Tom.
Every time you mention
43.58 at a close yesterday. Let's wrap this up. All-time highs yesterday. All-time highs on the S&P 500 yesterday.
Massive
So when we're talking
correction this
about
morning.
this move, down 2% in Europe on the Stock 600, down 61 on the S&P. Where are we now? Negative 61 points, down about 1.4%. We're coming across from all-time highs on the S&P, and we're coming off the year-end median price target on Wall Street. When we were in October, November time, when those headlines crossed about vaccine efficacy in early November and this market exploded on the cyclical side, those forecasts of anywhere near 4,300, Romain, that felt like a pipe dream.
It was.
6, 7, 8 months ago.
Yeah, and in fact, and we pushed back against a lot of that and really questioning a lot of those strategists just about how pie in the sky that was. And of course, including Jonathan Golub. And of course, we ended up being the ones who looked like we were wrong. But I think that when you look at the current levels here and you look at the crab walk that we've had to these record highs over the past 6, 7 weeks here, you do have to wonder whether some of the steam is running out of the engine a little bit.
Futures down by 1.4%, a bit into the bond market. You can see that at 127.62. Yields come in by 4 basis points. Heard on radio, seen on TV. Alongside Tom Keene, I'm Jonathan Ferro, together with Romain Bostic. Lisa Abramowitz is not in Crete, but she will be back on Monday.
She's not in
She's away. She's not in Crete. We can confirm that. I can't confirm where she is.
Sources.
She's told us she went to Greece. Direct source.
Sure.
Close to someone familiar with the matter and all that, said to not be in Crete.
Not sure.
On Monday, Lisa's back. Your equity market just coming off all-time highs.
Will we
in the
be back
next
on
hour,
Monday?
probably not. Secretary Buttigieg will be joining us, though. This is Bloomberg.
morning was a bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there. I think just about every model or every second model. I was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, those things have to be, you have to be mindful about that. But I think it's incredible what's been achieved so far, but, there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
If you have confidence in the economic outlook, equities are usually the best place to be.
There's a threat to the sort of pure reopening trade, that some of those sort of COVID-sensitive sectors have a harder summer than people were hoping for.
That baton of growth acceleration is getting shifted from the US.
The one thing that we're doing at the moment is we just all focus a bit more on fiscal policy.
The Fed will actually end up doing what it has to do, but it may be a little bit late.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene on radio, on TV, a simulcast of doom and gloom for the market pulls back this morning. We're going to dive into that, an important conversation with the Secretary of Treasury as well. John, I got to go right to what we've seen in the last hour. World coming to an end. The 10-year inflation-adjusted yield under 1%, negative 1.02. John, full recovery. We've come above that to negative 0.98. Crisis over.
Yeah, I don't know if it's a full recovery, Tom. I can sense in your voice you don't either. 127.95 on nominals right now. We come in 4 basis points off the lows. We had a break of 125. You've mentioned reals, Tom. We're still negative 97. We've had a big move in real yields over the last couple of weeks that have got a lot of attention. And when you see a price move and you try and fit a fundamental narrative to it, do you miss what is just a technical explanation? Is this just one monster position squeeze, Tom, that resets and eventually takes yields higher? Bob Michael of JP Morgan has taken that view.
Yeah, it's important what Bob Michael says. I've been going back and forth with our IRA jersey, head of all of our fixed income effort at Bloomberg Intelligence. And mostly, John, what we talked about was the short cover on bonds. Price down, yield up, oops, I'm wrong. And then you go the other way rapidly.
The emphasis at the Fed has turned. And that's the key element, I think, in this story over the last month. And one line jumped out to me in the Fed minutes, and this is the quote. A substantial majority of participants judged the risk to their inflation projections were tilted to the upside. So that's not a shift in the reaction function. That's not even a shift in the forecast. That's a shift in the balance of risks around the forecast. And that shift in emphasis was enough to spark what we're seeing play out on the screen over the last month.
And on the equity markets, Dow futures at negative 514 is a headline. SPX down 1.5%, 63 points. The VIX reached out with just a kiss of 21 as well. Is that a correction, Romain Bostic?
No, it's not a correction. We're far from that. And I think Jonathan Golub kind of hit it on the head a little bit earlier here. I mean, this is still a bull market. The sustainability, you can certainly maybe question it around the edges here. But keep in mind, we've had these dips before, and people have bought these dips. Today, obviously, a little bit more severe than what we've seen. In fact, when you go back over the past couple of weeks, we've really only had a couple of sessions where we opened lower. And then, of course, on both of those days, we closed higher here. So I think you are seeing people who do see opportunity here. They see an opportunity for rotation rather than an opportunity to exit.
Before we get to Katerina Simonetti, John, I do want to go through the data. I think we've got to do a complete data. I'm going to save bonds for you as you get ready for the real yield. Dollar churning here as well. John, I do want to point out renminbi comes back a little bit weaker. Maybe all the China news, 6.49 on yuan. We haven't mentioned that. And John, to me, the major news is what's not happening. Euro really doesn't move off the ECB announcement.
Euro's firmer, 118.37. Euro dollar out by positive 0.4%, but it's the move in the bond market that everybody is focused on. Yields are in 4 basis points to 127.78. Intraday highs of the year were 177. That was 50 basis points ago, and it was back at the end of March. And we keep beating this drum, and we have done over the last several weeks. This move is not new. This is not new. It's been developing now for the last several months.
We'll have to see. Right now on the management of money, we're going to get to this, and this is a good day to speak to someone at Morgan Stanley actually worrying about not losing money. Katerina Simonetti is with us in private wealth there. We rarely talk to people in the trenches, and we do so today. What's your biggest headache right now, Katerina, with people that say, I need to make money like it's in the market, but I don't want to take risk? What do you tell them?
Well, Tom, thank you for having me on the show. And it is such a weird environment that we're in, because on one side, our economic forecast remains to be positive. On the other side, for a while now, we have been calling for a correction, a pullback of some sort, anywhere from potentially maybe 10 to 20, 15%. And we are saying this in the context of the bull market, but we're preparing our clients for the fact that this economic cycle seems to be happening a little bit too quickly, and some type of a pullback here just seems natural and normal. And this is not the reason to exit the market, but certainly a good trigger to reposition the portfolios, to go to safety, to take some profits off the table.
Katerina, your colleagues, particularly in the investment bank, the likes of Ellen Zentner, Chetanaya, I'm thinking of Andrew Sheets as well, I'm thinking of Mike Wilson, they've been focused on this cycle as well and where we are in this cycle. And a lot of people are struggling with that as a framework, because the team at Morgan Stanley believe we're already experiencing a mid to late cycle dynamic, a mid-cycle dynamic particularly. Katerina, explain that to our audience, why we're already there so quickly.
Well, generally, these things take time, and bull markets last for a while. But because of so much stimulus and because of this whole, economic reopening that we're going through, everything is happening quickly. And we seem to be going into this mid-cycle area of the market known for volatility, which is known for corrections and pullbacks. So because everything is happening quickly and economy is so stimulated, and there's some developments and concerns that we're having right now, dealing with inflation, with labor shortages, with higher cost of materials. On one side we have this growth of recovery, on the other side we have the volatility. So we think that the pullback and the correction at this stage in the recovery, in this mid-cycle transition that we believe that we find ourselves in, it's only natural here.
Only natural, and this is a pretty broad-based pullback, at least for today. I mean, pretty much nothing of significance higher here, at least in the pre-market. Katerina, I want to go back to the economic data that we've been getting, which has been mixed, and it's been mixed pretty much for the whole year, despite the fact that most people have taken much more of a glass half full approach to it. There were a lot of surprises out of that data, a lot of upside surprises, and that seemed to fuel a big part of this bull run that we had over the first few months of the year. Those surprises have sort of flattened out, and I'm wondering if you read into that any sense here that even if the economy continues to chug along higher, the idea here that we'll be pleasantly surprised in any meaningful way is past us.
Romain, Romain, I think that one of the key factors here is that there seems to be a bit of a disconnect with the way Federal Reserve sees the inflation in the way that investors and consumers see the inflation in every single day of their life. And naturally, there are concerns. And so what we tell investors to do is to focus on earnings, to focus on quality, to focus on fundamentals, because I do believe that we are going to see the positive surprises. But we have to be very careful with our portfolio selection. We have to be very careful with our security selection. When we look at quality, we look at earnings, we look at the long-term opportunity, for the stocks to make sure that the valuations that we're seeing are actually supported by earnings, because we saw so much run-up in some of the sectors of this economy, in some of the individual equity, that the question is this sustainable? So if there is ever a time to go to quality, to increase the overall quality of investment portfolios, this is the time.
Katerina, we've got to leave it there. It's always good to catch up. Thanks for joining us. Katerina Simonetti there, Morgan Stanley Private Wealth Management Senior Vice President. Let's talk about some individual names. A little bit earlier on this program, Romain brought up Apple. Apple delivering its first new high since early January. These are names that really haven't done much at all. Today's a little bit different, and I think it's worth explaining. We've had rotation on, rotation off, and this morning you've got a broad-based decline in this market. The S&P's down 66, we're down 1.5%. You see that underperformance on the small caps, that downdraft in the NASDAQ, and Apple is also down almost 2% in early trading, Romain.
Yeah, and this is significant because yesterday afternoon, we were talking a lot about the breadth of yesterday's rally, the breadth of that closing high, and it was not necessarily as broad as you would like it to see, and we've seen that breadth come down here. And so then when you come into a morning like today and you're seeing everything in the red, I mean, there's no large cap stock right now in the green right now. Levi Strauss is pretty much it, and I don't even know if you can really factor that in. You talk about the Apples, the Amazons, the Microsofts, all these stocks that led us to all-time highs over the last few days. You talk about all those cyclical names, the airlines, the travel stocks, the material stocks that had us at all-time highs back in March, April, May, all of them down here today. And you do wonder if this is that pullback, if this is a correction, and if it ends up just being a reset and we end up moving back higher, or this is a real sort of walk back of that.
Is that on the edge of doom there, TK?
It was
almost.
Am
I getting better?
Romain Bostic is a wonderfully optimistic person. It's because he's sitting in that chair. He is at
Something
that podium.
That
the
chair.
gloom just
I think what Romain did earlier was important, though. He alluded to something really, really quite critical, and I've been banging on the same drum as well. This isn't new. Your 10-year yield topped at the end of March. Break-evens topped in May, and you're starting to see this bleed over to the equity market as well, with the banks in early June and the airlines as well. And I want to sit on the airlines for a moment. American Airlines is 20% off the highs of early June.
Yeah.
This summer is not the summer we imagined 12 months ago. 12 months ago, I think we all thought that international travel was going to be wide open. The idea that this London-New York corridor, Tom, is still not fully functioning. I had a friend fly from London to California yesterday, and I had a picture of the cabin. And in coach, there were 2 people in the whole cabin. And Tom, that is not getting it done for these airlines.
I totally agree, John. I'm not read in on this like you are, but, to mention the Secretary of Transportation coming up, I mean, South Bend to O'Hare to LHR, can you really do that at this moment? John, I'm not sure you can.
It depends who you are. You can certainly do the domestic leg here in America. That's wide open. The international story isn't.
Okay, so I'm not gonna die on the domestic leg, but I'm gonna die on the international leg?
And isn't that the problem, Tom? Where's the science here? We're gonna have that conversation in a moment. Where's the science here? What's the scientific rationale not to have made a move on this? And the same data points in the same countries when it comes to the vaccine. You've got the UK coming up with a new travel arrangement from July 19th, but it doesn't have the reciprocal arrangement with the United States. So, Tom, what use is it for the London-New York corridor? And the fact of the matter is, right now, not much.
I just would say document it and get it done. John, you've lived this with your travels. We make jokes about it, folks. But, all of us at Bloomberg have a whole team helping people try to get around all of these different rules. And, John, it does come down to when do we get rid of quarantines? I mean, that's the heart of the matter.
It's been a nightmare for a lot of people. And we'll talk about some of this with Pete Buttigieg, the U.S. Transportation Secretary. He'll be joining us shortly, live on radio, on TV, on the infrastructure effort down in Washington as well. Your equity market down 1.6 on the S&P. We're off by 3 points on a 10-year, 128.62. We're off session lows. And what a session is developing going into the opening bell. In about 20 minutes, initial jobless claims. And then an hour after that, the opening bell in New York City. This is Bloomberg.
with the First Word News. I'm Rishka Gupta. In Haiti, police reportedly have shot and killed 4 suspects in the assassination of President Jovenel Moïse. According to the Associated Press, 2 others were arrested and 3 police officers who were being held hostage were freed. Still no word on who the assassins were. The European Central Bank has raised its inflation goal to 2% in the medium term. Policymakers also signaled they may treat deviations above and below that target with equal vigor. All this was part of an ECB strategy revamp aimed at bolstering the economy after what's been years of lackluster prices and growth. Tokyo looks set to stage an unprecedented Olympics largely without spectators. A new coronavirus surge has led to a state of emergency in the Japanese capital. There are multiple media reports that fans are expected to be banned from all Olympic events in Tokyo and the surrounding areas. And the EU has imposed fines totaling $1 billion on Volkswagen and BMW. Regulators say the 2 companies colluded to delay the rollout of emissions cleaning technology. Mercedes parent Daimler avoided a fine for being the first to tell the EU about the cartel. More than half of U.S. hospitality workers wouldn't go back to their old jobs, and over a third aren't even considering re-entering the industry. That's according to a poll by employment search engine Jobless. The survey underscores the hiring challenges for restaurants, bars, and hotels. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television. again.
Broadway's returning June.
Have you bought tickets?
He's busted out.
You've got
all
more
over.
time here. If you want.
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I happen to believe that there will be a movement ahead in CapEx. We think there will be an infrastructure bill of some sort. Obviously, we're not privy to the negotiations now in the Congress. We think there's a desperate need for spending on infrastructure, but there's also a need for private engagement in CapEx.
And us to catch up with Abby Joseph Cohen, Goldman Sachs Advisory Director and Senior Investment Strategist from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Together with Romain Bostic, Lisa Abramowitz is out until Monday. 42.88 on the S&P 500. Equity futures down 62. We declined 1.4%. This bond market is firm, particularly over the last couple of weeks. We give up some of that move, though, from earlier this morning. Yields are lower now by just 3 or 4 basis points to 128 after a break of 125, Tom, a couple of hours ago.
Really interesting, and we'll keep abreast of the markets here. Again, the VIX out near a 21 level, but there's some calmness here in the last hour. It is not a calm time for our Secretary of Transportation, Mr. Buttigieg. Of course, we all know from South Bend, Indiana, sterling academics, including something that we all did as a kid. Could we write an essay off John F. Kennedy's Profiles in Courage? And the Secretary delivered the goods as a young kid. We want to talk about transportation. We want to talk about international travel. But yes, right now on infrastructure. Mr. Secretary, thank you so much for joining Bloomberg this morning. I lived the last infrastructure disaster, which is you drove out Indiana West, and there was a point where I-80 died, and you had a 2-lane highway west. We're going back to that on the condition of our infrastructure, and we're doing it because we cannot figure out how to do a gas tax. Can't you do a gas tax that will pay for the roads, rebuild America, and also be politically acceptable for Democrats?
Well, it turns out you don't have to. And what's so great about the bipartisan infrastructure framework that the president led on is that it will deliver the biggest investment in American infrastructure in more than a generation. The biggest investment in our roads and bridges since Eisenhower, the biggest investment in passenger rail since Amtrak, the biggest investment in public transit ever, without having to ask Americans to pay any more in taxes, any American who makes less than $400,000 a year. This was a promise that the president made when he was running for president. He plans to keep that promise, and so he was very firm on that. But what's clear is that it is absolutely possible to make these kinds of investments by looking to other funding sources that don't ask that of ordinary Americans. And we're thrilled that this critical mass of Republican and Democratic senators agree. We think it's one of the reasons why so many Americans agree that this is the right thing to do. Now we need Congress to move it forward, get it to the president's desk so that we can get those dollars working, whether it's on our highways and bridges, our airports and ports, or on some of the things that are newer to the infrastructure picture, like our digital infrastructure and getting everybody online.
You mentioned Dwight David Eisenhower. I remember going off the infrastructure road of Kansas onto the 2-lane highway to his museum. All wonderful. Dwight Eisenhower had to fight his Republicans to get the vision of the interstate highway system done. How can you bring over Republicans to get a majority vote to rebuild America?
You know, I found that people don't agree on much here in Washington across party lines, but they agree on the need, as you've been describing, and as every American sees. You know, when I'm talking to House or Senate members, Republican or Democrat, what I notice that they all have in common is they're all from somewhere. They're all home right now, actually, this week during this July 4th recess. They're all home talking to constituents saying, when are we going to get this bridge fixed? Why is our airport looking the way it's looking? How are we this far behind on transit or whatever it is in their district? And so, yes, I do believe that we have finally reached this point of, if not consensus, then overlap. And I think that's why you had this remarkable sight of the president walking out of the West Wing a few days ago, flanked by Democratic and Republican senators saying, we have a deal. Now,
We have a deal is not the same thing as we have a bill. That's what's happening right now, turning it into legislative text, moving it through these processes, committees that have jurisdiction over this. There's a lot of machinery, especially this month of July, that is going through its motions here in Washington. But it's resulting, I believe, in the opportunity for something that we have needed for really the better part of my lifetime, as we've watched these investments degrade, as we've coasted off of decisions that were made generations ago. You know, last time I was in New York was to look at the Hudson River tunnels, the finest infrastructure technology of 1910, and we're still depending on
look
it
at that
for the
shade,
Northeast
John.
Corridor.
Look at the shade the Secretary gives to New York City.
Mr. Secretary, there are some things that are easy to get done and haven't been done. Infrastructure is one of them, I guess. Another is international travel restrictions. We're trying to work out when we get an update from your administration. When is that going to happen?
So, unfortunately, it can't be based on an arbitrary date. It has to be based on conditions. But I can tell you, as the Transportation Secretary, of course, I am as impatient as anybody to see us move as quickly as we responsibly can toward more forms of reopening. Right now, what's going on is a set of working group processes. So we've convened working groups with our international partners. There's one for the UK, one for the EU, one for Canada, one for Mexico, to determine the right pathway forward. A lot of this is based on what's going on with progress on the vaccines. Obviously, we see good news and bad news out there in terms of the variants. One moment you're reading about a variant happening across the world. The next you know, it's becoming the dominant strain here in the U.S.
And it is, sir. And if you allow me to jump in, because we're pushed for time, the Delta variant has become the dominant strain here in the United States of America, according to the CDC, and very quickly so too. From my position personally, forgive me for saying this, but you didn't have to watch your father's funeral down the screen of an iPhone on Tuesday. I did, because of your policies. Now, I expected you to bring up the science, and I expected the quote that came from you to be used because you used it a month ago, 2 months ago. Here are the policies for our audience so they understand them. Currently, if you're a citizen of the United States of America, or if you have a green card, you can travel to the UK and you can fly directly back. If you have an H-1B visa or an L1, you can fly to the UK, but to come back to America, you need to go to Mexico City and spend 2 weeks there in a third country to get back to New York. Sir, forgive me, but I've spoken to scientists about this, and there is no scientific rationale for that policy. So for me and thousands of others who haven't got to be with their loved ones through a critical time because of your policies, sir, there will be thousands more if you carry on repeating the same line and don't just look at this and change it. Why are you not changing the policy when we have scientists day after day say there's no scientific rationale for maintaining it?
Well, first of all, let me say I'm sorry to hear about your father. And let me also say that I am among those who are impatient to see loved ones who live across the Atlantic. Let me also say that the U.S. is going to be conservative in dealing with a phenomenon that has led to the deaths of 600,000
You keep going back to this, sir.
And so
there is no scientific rationale to draw a distinction between someone who has a green card, an H-1B visa, or an L1. You know that. I know that. Regardless of anything you say for the next couple of minutes, it's not going to justify it. What I need to understand from you as a policymaker is why thousands of people who live in this country legally and pay taxes cannot go home to see loved ones and return directly, and why you still repeat the same line again and again and again. It doesn't make it true. You do not have a scientific rationale for this. You cannot back it up with science, sir. Why are you not going away with policymakers and doing something?
So our tools are imperfect, right? We are dealing with a country-based framework for assessing risk, when in a perfect world, we would know all the information we needed to have for a traveler-based framework. We can move in that direction somewhat. That's more refined and ultimately more accurate from a risk assessment perspective. But we don't have the toolkit to do that in a way that would be as smooth as we would want. So we're going to continue to have a strategy led by public health authorities, guided by Homeland Security, CDC, my department at the table, to reopen travel as quickly as we responsibly can.
Secretary Buttigieg, I'm not talking about a broad-based reopening, though. Forgive me for jumping in. No, just allow me to get this thought in, because it's important to what you're about to say. I need you to understand that I'm talking about working people in this country who are working here legally. With the stroke of a pen, you could enable thousands of people in this country who work illegally and pay taxes to return home to loved ones. And you can do that by making an equal treatment for people with an H-1B, an L-1, a green card, and a resident of this country. You know that's not difficult. That's not a large change. That's allowing people who work in this country to get back and see loved ones like they want to. And sir, I'm not going to lay on this on any thicker than I already have. You didn't have to watch your mum stand by your father's casket in a funeral 2 days ago because you won't do what I'm describing. It's easy. And us together in this conversation, I hope you go away and make the changes so that thousands of other people don't have to go through what I've gone through in the last month. Can we make that happen, sir?
So these are exactly the kinds of things that we're reviewing on a daily basis. I'm the transportation secretary. My entire job is to do everything I can to safely get people to where they need to be and where they want to be, whether it's to be with loved ones, whether it's to do business. It's literally what I'm here in Washington to do. Nothing about this, respectfully, nothing about this is easy. We're dealing with a phenomenon that has led to the deaths of 600,000 Americans. We're dealing with imperfect information, complex policies, legacy policies. Nothing about this is easy. But what I will tell you is we are doing everything we can as quickly as we responsibly can to get back up and running.
Mr. Secretary, would you support a passport equivalent? I have a passport. I happened to study microbiology a few years ago. Why can't I get a passport, a federal passport, that says I've been vaccinated?
Well, there are a lot of privacy and technology issues, but I do think it's worth noting, you may have had this experience too. I had it when I was younger, traveling internationally, of carrying a yellow CDC passport that reflected the vaccinations that I needed to demonstrate that I had to travel to parts of Southeast Asia and Africa. We have forms of this that are frankly very low tech and out of date. How to balance that with the privacy issues is a challenge, and we've decided that it's not the federal government's job to establish these kinds of requirements, but it is important to make sure that there are ways for people who want to demonstrate that they are vaccinated to prove it. And we've seen a lot of third-party and private sector ways to do this, and I think that's going to continue to develop and needs to have continued support at the policy level too.
What's your biggest headache right now in getting this infrastructure plan through? I know you're managing a message every day, and certainly we've seen that with President Biden. This is a big emotional piece of American legislation. How do you get it through with a fractious Senate?
I think the biggest thing is not to let the politics get in the way. Look, people are impatient for this to happen, but it's been infrastructure week for a good decade or so, and we need to demonstrate that it's actually going to get done this time. The policy framework is clear. The pathway forward is clear. We need these roads and bridges. We need better airports. There are listings of airports where not one of the top 25 is actually in the United States. That's unacceptable to the president. I think it's unacceptable to most Americans. We want to get this done. The biggest thing we have to do is actually move it through Congress and make sure that as this turns into the very specific mechanical legislative text, that we're tearing down any obstacles to getting it to the president's desk. But I feel an enormous amount of momentum for this on both sides of the aisle. And our job is to make sure that momentum gets us all the way across the finish line.
Mr. Secretary, I appreciate your time this morning, and thank you very much for hearing us ask our questions and for responding them too. Pete Buttigieg, the U.S. Secretary of Transportation. Some economic data in America. Let's turn to Mike McKee for that. The wrong kind of upside surprise on jobless claims, Mike.
Although not much of one, John. It's about a 2,000 increase over the prior week because that was revised higher to 371,000. 373,000 jobless claims filed last week. That's more than the survey of 350,000, but we're still at much lower levels than we were during the pandemic, of course. The average of the 5 years before that was 230,000. So we're getting there. It's just taking longer. The real question is not so much the initial claims that are being filed, but the continuing claims claims now, and that's at 14,209,000. That's the number you want to see come down as people move out of the labor force or move into the labor force and try to get jobs. So we're keeping an eye on that. And some of the states where we saw them end the unemployment benefits early, both Alaska and Iowa, which ended theirs a couple of weeks ago, saw jobless claims drop during the month. But Mississippi saw jobless claims drop by 8,000, and New Hampshire saw jobless claims rise by 3,000. So is there evidence that we're seeing people go back into jobs because they can't get extended benefits? Not conclusive yet.
Well, there's a weekly data point. Michael McKee, I want you to talk about, I want you to save us here this morning as we look at the yield market and the equity markets and the worry about the trajectory of growth. Forget about the Fed. When you read all the market strategists out there, the market economists out there, we talk about a boom economy and then a sort of boom economy and then not a gloom economy, but what we used to know. How has that timeline changed in the last number of weeks of the research you've read?
Well, it hasn't particularly changed. The psychology changes, and that's the difference maybe between the Fed and the markets. If you're the Fed, you could afford to wait. You could afford to say at your meeting that we don't know what's going to happen with inflation and unemployment. We think we have a theory, but it's going to take months to prove whether we're right or not. But if you're an investor, you've got to trade on a daily basis, and so you're trading the psychology of the moment, and the psychology of the moment is the Delta variant is getting established in a lot of places, and maybe that's going to have an impact. But again, we don't know at this point.
When we look at the continuing claims here and the trend line that we've been seeing there, Mike, it doesn't seem that it's come down a great deal over the last couple of reports here. And I'm wondering, at what point do you start to be a little bit concerned about that?
Well, that's the question for the Fed. And while we say jobless claims aren't related to payrolls in a direct way, they do have sort of a relationship in terms of where people are in the labor market. And we're not seeing people getting jobs at the rate that we want to, and we're seeing this elevated level of claims. And so they should move together. Claims should start coming down as more people come into the labor force and get jobs. But that may, at least according to Fed thinking and a lot of economists, that may not happen until the fall, when schools reopen, when the extended unemployment benefits expire for everybody, and people are forced into or able to get jobs. So that's something that's something we want to keep an eye on. And as these extended unemployment benefits end in a lot of states, that should also push that number down. But does it push it down a lot before September? That's the question.
Michael McKee, thank you so much. Greatly appreciate it. It's not a once-a-week visit with Mr. McKee, but Thursdays we do claims as well. Christine Lagarde is beginning to explain at a symmetric press conference the symmetric change in ECB policy. I believe she's going to answer some delicate questions there, and we will follow that, of course, our team in Frankfurt and in London as well. And we will see how symmetric she is in answering some sensitive questions, perhaps certainly from the German media as well. James O'Sullivan joins us now, TD Securities Chief Macro Strategist. Jim O'Sullivan has been extremely good at linking in market economics into what it means for the markets. We're thrilled that Jim O'Sullivan could join this morning. Jim, I want to talk about the idea of the signaling processes that you see out there. Is the market signaling the Fed, or is the Fed signaling the markets?
I mean, it's a good question. And yeah, frankly, we're a little puzzled as well by the rally in the bond market over the last couple of months. I mean, for the most part, I mean, the U.S. economy seems to be recovering fairly well. Obviously, we just saw an 850,000 increase in payrolls last week. The ISM numbers, have come down a little bit. They're still over 60. And of course, it's inevitable that the boost from reopening and from fiscal stimulus will fade. We don't expect to keep seeing 7 or 8% growth indefinitely. So inevitably, there's going to be some fading of those over the next year. But I mean, at this point, yeah, the economy seems to still be pretty strong. And I mean, it is a little bit of a puzzle, frankly, that the bond market has rallied as much as it has over the last couple of months.
It has rallied because of price up. I don't want you to, go into full fixed income mode and certainly overnight repo mode. But does it concern you to see the oddities in the very short-term market? Link that into what our listeners and viewers live every day in a more long-term bond, note, and bill market.
Well, when you say short-term market, you're talking about the very short end of the curve, or just the daily?
I'm talking about the wall of cash that is out there that has distorted all of the trust market inside 6 months.
Well, I mean, there's certainly a flood of money in a QE world that the Fed is in right now. I mean, certainly the Fed is still buying 120 billion a month of bonds and pumping that money into the banking system essentially. So bank reserves are being flooded. So there's a huge amount of short-term money, and of course the Fed did just tweak its short-term administered rates, the repo rate and the excess reserves rate, to push those numbers back up. But we're living in a world where there's massive monetary accommodation, and that's putting short-term rates at close to zero. And that's not about to change anytime soon. I mean, what's being talked about the Fed, of course, is just backing off on the QE part of the program. And that'll slow down the increase in all these reserves, but there's certainly no talk about taking them back anytime soon.
Yeah, the monetary accommodation remains. The expectation is for it to remain. Let's talk about the fiscal policy and fiscal policy accommodation here. There was a high expectations heading into this year about the type of fiscal stimulus and fiscal spending we would see. That hasn't quite worked its way through Congress, and now there are some doubts about whether we'll see, I guess, the full proposal actually ever come to fruition here. Jim, how is that factoring into your outlook?
Yeah, I mean, that probably is a bit of a factor for the bond market, although I think it's always been true that the next round of fiscal policy was going to be more of a long-term plan over the next 8 to 10 years. So it's not so much about 2022 or even 2023. I mean, meanwhile, it's always been true that the huge amount of stimulus that's been in place due to COVID over the last year and a half was very much front-loaded, including the 1.9 trillion stimulus plan that was enacted in March, shortly after the president took office. So that stimulus is going to fade as you get into 2022. And that is a reason to expect growth to be much slower next year than it is this year. And of course, that's almost inevitable given we're talking 6-7% growth this year. But meanwhile, yeah, it looks like it's a challenge to get that long-term plan in place. There's a lot of negotiations still to be done. In the end, it looks like something will be done. There seems to be some kind of an agreement on the infrastructure, small part of the infrastructure part, but there's a lot more negotiating to be done. But in any event, that longer-term plan is more about the next 8 to 10 years. It's not so much about 2022.
Hey, Jim, it's good to catch up, sir. Thanks for your time this morning. Jim O'Sullivan there, TD Securities Chief, US Macro Strategist. If you're just tuning in on TV, on radio worldwide, here's the price action for you. Down 59 on the S&P 500. We declined about 1.36%. Off session lows, we're still declining. A similar story in the bond market. Treasury yields saw a break of 125 a little bit earlier this morning. We're now at 127.62. We're down 4 basis points. A little bit later on the open, in about 21 minutes' time on Bloomberg TV, we'll be catching up with Jerome Schneider of PIMCO. And what a timely conversation, yes, Tom, to have on this bond market. This is not where people thought we would be at this point of the year.
And that could be a 1-hour conversation. Jerome Schneider, just expert at linking in the duration market, call it 6-month T-bills, even 3-month paper, on down to, as I mentioned, John, the trust bond market is shattered. This overnight repo market, it's all a bunch of highfalutin mathematics and knowledge. They talk in Greek, John, but Jerome can translate that.
What did you make of that claims data, Tom? 373, just the wrong kind of upside surprise there.
You know, I'm glad you mentioned it, John. We didn't have time with Mike McKee. I looked at the chart, and by no means does it violate the trend to a better set of statistics, a better feeling about employment in America. It's another data point, but the continuum of the trend is still very much intact.
I'll run you through the opening bell on TV. Tom Keene will do that on radio, and then going into the close. Romain Bostic putting in the long shift. Romain, what's the focus for you today through the session going into the closing bell?
I think the breadth of the sell-off combined with the lack of breadth that we saw in the rally over the last few days, and whether you put that together and whether it spells the idea that some of the steam is maybe coming out of this market.
TK?
I lost my train of thought. I was thinking about Italy, England, and, you know, what they would...
you don't want to talk about travel restrictions?
No, the breadth thing is like a big deal. Frankly, the breadth is a big deal. It has not been there, and that's worth a lot of study.
Yeah, and we're going to have a good conversation. We should point out that game was aired actually during the close yesterday.
How does that work, Romain?
Caroline Hyde spent the entire show looking at her phone, checking the score.
Remain Bostic.
The entire show.
Alongside Tom Keene, I'm Jonathan Ferro.
Outrageous.
Equity futures down 57 to 42.93 on the S&P 500. From New York City this morning, good morning. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. A 2-week search for survivors of that collapsed condo in South Florida has come to an end. The operation has now shifted to a recovery effort after authorities concluded there were no longer any chance of life in the rubble. Crews have recovered 54 victims, with 86 people still unaccounted for. It's another sign that the rapid spread of the coronavirus Delta variant could wreck Europe's summer. France is warning its citizens not to vacation in Spain and Portugal. Those two countries have the highest 14-day case notification rate in Europe after Cyprus, and both rely heavily on tourism. In China, the government signaled the economy needs more support from the central bank. Authorities hinted that the People's Bank of China could make more liquidity available to banks in order to boost lending to businesses. One way to do that, of course, is cutting the amount of money the banks have to keep in reserve. China's recovery from the pandemic has shown some signs of faltering recently. And in China, Tesla has unveiled a significantly cheaper version of its locally built Model Y SUV. That's after a string of negative publicity that may have hurt consumer sentiment towards the electric car-making pioneer. The so-called standard range Model Y starts at a little more than $42,000, about 20% less than the original longer range Model Y. 36 states have sued Google, accusing the company of abusing its power over app sales through the Google Play Store. The suit, filed in San Francisco, says that Google used anti-competitive tactics to thwart competition. The company says that the lawsuit gets it wrong. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning, everyone. Bloomberg Surveillance, just a very interesting half hour to speak to the Secretary of Transportation on infrastructure and on international travel as well. We do this with the markets, somewhat of an improving tape this morning off the great difficulties that we saw 2 and 3 and 4 hours ago. Right now is a special moment, not only for Bloomberg Surveillance for all of New York City, but indeed it is a national story. Eric Adams is the Democratic nominee for New York City mayor. This is 2 other candidates did not go for a recount and conceded in the last 12, even 18 hours. Joining me now for a conversation with the Democratic nominee is, of course, Romaine Bostic and for Lisa Abramowitz. And we're absolutely thrilled to have Shelley Banjo with us. She has driven our coverage here at Bloomberg. This started out as, another race, and then it became something different. Eric Adams, thank you so much for joining us this morning. I'm going to let Shelley talk about ear piercings and all that we've seen in the last 24 hours. I want to talk about your first meeting as mayor with the New York Police Department. How do you envision that will go?
Well, first, it started already, and it's not with the department, it's with the union heads. I had a conversation with Pat Lynch, a conversation with Ed Mullins, a conversation with the president of the DEA. It's about going behind closed doors and say, let's turn a new page. I said this over and over again, the prerequisite to prosperity in the city is public safety and reform. And they are eager to sit down with me and say, how do we move policing into the 21st century, deeper into the 21st century, where we reestablish the relationships between police and community, because our cities will be controlled by the good guys or the bad guys. And right now, all across America, the bad guys are winning. And I'm going to stop that immediately.
Are you going to do that with Dermot McShay at the helm?
No, I'm not. I've made it clear that my police commissioner is going to be a woman. We're going to finally bring the entire city, the largest police department in the country, into the 21st century of women leadership in law enforcement. Yeah. And I'm look at 3 of the candidates that I've been communicated with.
And I'm sure you know, obviously, being a veteran of that force, that's not going to come easy, Eric. We've seen the fraught relationship between the police, the rank and file, the unions, and, of course, the mayors of the past here. You've also had a relatively complicated relationship, despite being a veteran of that department here. How do you bridge that, Eric? How are you going to do that in a way where the police, which are a mighty force in this city, Eric, some would say even mightier than the mayor himself?
Well, first of all, it is easy. And those who state it's not going to be easy, they don't know me. I had difficult challenges in my life, being beat, arrested by police officers, assaulted, went into the police department for reform, moved up through the ranks of captain, became a state senator, now borough president, reversed diabetes by changing my diet. And so difficult challenges is not something that I run away from, I run towards. What we must do is stop talking at each other around reform and safety and start talking with each other. And you're going to see in the first year a complete change in the atmosphere of public safety and how our police officers respond. We're going to rid the bad cops, we're going to back our good cops, and we're going to reestablish the relationships in our communities. And it's going to be done in year 1. I promise you that.
The 3 women that you're currently in conversation with, are they within the New York Police Department, or are you looking outside?
What I don't want to do is say, is it bigger than the bread box or smaller than the house? Because that limits the number of potential candidates, and many of them are working right now. And I don't want to in any way jeopardize what they're doing. I will reveal those numbers immediately after I win the general election in November. I reveal the individual I decided on.
Fair enough. Fair enough. And another big force to be reckoned with is obviously Governor Andrew Cuomo in Albany. You have had a checkered past, so to speak, with him, but you guys have run in the same political circles for almost your entire adult lives. Did he call you to congratulate you? And what's the first thing you're going to try to work with him in Albany on?
And we don't have a checkered past. Clearly, we are both strong in what we believe. We know how to sit down and communicate. We've operated together when I was in Albany, and I'm looking forward to having him as a partner as we deal with, number one, public safety. I cannot really emphasize this enough. We're not going to deal with major parts of our economy, tourism. If we have shootings in Times Square, no one's going to get on the subway system if we continue the violence there. And so we're going to first deal with making our city safe, and then we're going to use the dollars that are coming from the federal government to go after the feeders of crime and the feeders that prevent people from finally leaving institutional poverty year after year. And I believe that having a partner in Albany, we could accomplish this task together.
Eric Adams, they're going to study your candidacy, the path of this mayoral race for you in Brooklyn, in Bronx. They're also going to study it in Boston and also in Boise, Idaho. You're going to have a national ramification for all Democrats. What does your victory say about the certitude of the left in the Democratic Party?
Well, if you are a DSA candidate or if you are a Republican candidate, you don't want to be pushed on a train or slashed.
Right.
So I think that what you're going to see, I'm the face of the Democratic Party. I keep saying this over and over again. I won 4 boroughs in the city of New York. The only borough I did not win is Manhattan. My message resonated with everyday working people. And it didn't matter with your ethnicity, your gender, it didn't matter. Worship. And I think that you're going to see this message resonate across this entire country. And it's an opportunity for us to understand that we don't have to talk at each other. We are in this together. And I'm going to bring the city closer together so that we can overcome not only the pandemic, but also the pandemic of unemployment, of violence, and inequality.
Very quickly, Eric, we are on television and we are on radio, and a number of radio listeners have emailed in and said, what's the piercing look like? Where's the piercing this morning, Mayor Adams?
Look at this.
It's a gold earring. My son and I, we attended a meeting with a group of young people during the campaign, and they said that we will vote for you if you commit and promise to get your ears pierced, if you win the primary. And a promise made is a promise kept. And I did it yesterday.
I can assure you the 108th mayor of New York did not go through this torture. Eric Adams, thank you so much. We look forward to speaking to you again. Let's be clear, the Democratic nominee for New York City mayor. I believe there's an election coming on as well. Shelley Banjo, very quickly here, your thoughts on this conversation.
I thought it was great. I mean, Adams has a real big challenge ahead of him. He's made huge promises on crime. He said, I'm going to reduce crime. That is not an easy thing to do. And if he doesn't do it quickly, people are going to get upset.
Romaine Bostick, your thoughts, please.
Yeah, I wanted to get some questions in there on education, too. That's obviously a big factor, a big part of the reason also why I think he lost Manhattan. It'll be interesting to see how he addresses that.
Very good. That was a very interesting moment. We leave you with the interesting moment of the market. Futures at negative 57, Dow futures just near negative 500. Stay with us. The open is next on television. I believe they'll talk about the markets. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City for our audience worldwide, good morning, this Thursday morning. Only one market to look at, this bond market, your 10-year, 129.12 from New York City. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
From New York, we begin with the big issue, the cyclical trade breaking down.
Cyclical parts of the U.S. economy slowing. You've had a correction in cyclical equities.
Rates have been rallying and flattening.
Yields have been correcting.
The bond market is already starting to focus on a slowdown.
Peak growth acceleration in the U.S.
Probably a peak rate of change in this quarter.
The rate of change is really what matters the most.
We're transitioning out of the broad reflation regime.
When everybody got into the reflation trades,
pretty much all investors and traders were short coming into March, April.
They're taking off their curve steepeners.
We're seeing this positioning unwind.
You're being given an opportunity to reset shorts here in the long end of the curve.
It's going to be a little tougher in the short term.
Joining us now is Invesco's Noel Coram and Jerome Schneider of PIMCO. Noel, I want to start here. I've started here every single day for the week so far. This bond market, yields breaking 125 earlier, back to 129 right now. Here's the question of the moment. What is going on?
It's a good question. For us, we just kind of take it back to why we originally put on this reflation trade. We expected growth to be strong. We expected inflation to be strong, but messy enough for the Fed to stay on the sidelines. And we continue to think that growth has been strong. We expect Q2 to, as we see the data to come out to reinforce that. And we are currently seeing it. Inflation has definitely been messy, but a lot of it is linked to the COVID impacted sectors. And we're still pretty confident in that if you look at the underlying data of the inflation. And we are seeing some signs of that dissipating. If you look at wholesale auction for used cars, those prices are coming down. So we're confident, again, that these are transitory moves. Things that, we need to be watching, of course, are wages, the mixed jobs data. And then at the end of the day, though, we think that the Fed is going to remain patient. And they made that pretty clear in yesterday's minutes, despite, a little bit of kind of opposition from some market participants.
Yep.
Committee members.
Jerome Schneider, your take, please.
Yeah, absolutely. I think what the Fed minutes did yesterday was more of an inciting action. It really put that healthy debate of inflation and Fed outlook really, more in line with what market participants were looking for, which is that healthy debate. Ultimately, what it means is what we're seeing this morning and for the past few days is a little bit more volatility in the market, the potential for overshoots up and down in terms of yield and risk aversion. And this is likely going to be with us for some time as we sort of reconcile the nuances of Fed outlook and what the policy is and what it means to the timeline of potential tapering and the future of monetary policy here. So while front-end rates might remain steadfast low for quite some time, the reality is that this debate will be with us as well for quite some time.
Inevitably, you've both turned to the Federal Reserve, so let's go there. And what seems to have changed over the last month or so is not a shift in the reaction function, not even a shift in the forecast in a material way, but Noel, it seems to be a shift in the balance of risk around their forecast, where we've seen a change, if at all. And just that shift of emphasis has been enough to trigger this huge squeeze of short positions in the Treasury market. Do you think that's all it is?
Yeah, so what's happening here is, back when we were in the crisis, there was one voice of the Fed. Now you're seeing some opposition. As Jerome said, this is healthy, right? We want to see this. But what I think is happening here is the front end is becoming a little bit less anchored. You've seen even, since the June meeting, the rate hikes being pulled into 2022. And we just don't think that the data is there yet to really allow for that to happen. But that's definitely something that we'll be watching, of course. But you're just seeing a little bit of opposition here at the Fed.
What are your thoughts on that particular theme, Jerome? That we are seeing some opposition, and maybe a lot of people are starting to think that the risk to their inflation forecast might be tilted to the upside, just as this market's getting over the whole ordeal.
Well, I think perhaps, what we read into the Fed minutes is perhaps not as dovish. There's still even a healthy debate at the Fed, not just in the markets. And I think that timeline of tapering where there was a group of people who really were focused on continuing that evolution of that tapering process. I think what's different this time is that communication metric. Powell has been very decisive about making sure that the market was well poised to accommodate and digest any move toward that tapering progress, and we saw that in the nuances of the language yesterday. So while the minutes at their headlines weren't that that impressive, the reality is that was just really confirming that they're going to continue on this process. More importantly, I think what we're seeing in the market is a bit of technicals. There's a bit of supply dearth, not only in the front end, but out the curve in terms of auctions and things like that. It is the summertime. Risk tends to get to extremes at various points in time. But I think ultimately what we're seeing here is the notion, and coming back to what PIMCO said for quite a long time, is that this inflationary concern is a bit transitory, and maybe the market's coming back to the point that growth isn't necessarily going to be gangbusters for a long time, higher than it was definitively in 2020, but coming back off of some of the peaks that we've seen. So as an example, in Q3, at PIMCO, we originally thought that GDP would be closer to 8%. It might be closer to 5 or 6%. And so these are still extraordinary numbers in the context of things, but it's still lower than people think. Does it warrant necessarily the rallies we've seen? Perhaps not. But this is exactly the volatility that investors need to be thinking about. And more importantly, it might warrant a more defensive posture in terms of how they think about their risk allocations over the medium term here. Because this is, again, as I said, a healthy debate that's going to be with us for some time.
Well, a couple of points you're making. One is on the forecast and the potential for deceleration, and then there's the market call. Let's get to the forecast and the risks around those forecasts. This is the quote that came out in the FOMC minutes, and I'll read it to our audience. Although they generally saw the risk to the outlook for economic activity as broadly balanced, a substantial majority of participants judged that the risk to their inflation projections were tilted to the upside. I want to bring in Mike McKee for a little bit more on this. Morning, Mike.
Good morning, John. Well, let me pick up on something Jerome said about the Fed and its outlook and how long this is going to be with us. This is a fascinating chart I'm starting with here that I shamelessly stole from the folks at Bloomberg Economics, but it shows that when the number of Fed officials who think inflation is rising reaches a peak, then the core PCE also reaches a peak. So we may be at peak inflation right now. You can see the effect right there, and it holds pretty well throughout the last number of years. So this may be the worst of it in terms of inflation. And because they don't know that, let me give you another couple of quotes here from the Fed minutes that matter. Various participants mentioned that they expected the conditions for beginning to reduce the pace of asset purchases to be met somewhat earlier than they had anticipated. Well, that's the inflation side. Uncertainty around the economic outlook was elevated, and that it was too early to draw firm conclusions about the path of the labor market and inflation. So they want more time. They don't want to have to make a decision 3 weeks ago. And you look at the jobless claims numbers today, and you don't get any real read on the labor market. Jobless claims 373,000, not much different from last week. The total number of people getting claims, 14,209,000, though, does fall significantly from 14,658,000. So people are starting to leave the unemployment rolls. The one other thing that I wanted to point out here, John, too, is when this debate comes to a head and the Fed announces it's going to start tapering, when you have yields where they are now, where do they go from there? Tapering is not tightening. That chart that I just showed you there was what happened to the 10-year yield during the Fed's taper of QE3. It went down. So does that mean we're going to see worse financial conditions? Does it mean we're going to see a worse economy if the Fed starts tapering?
Yep.
Something to keep in mind as you
Mike,
debate.
I think this is the question of the moment, to be honest with you, and a question that I asked a little bit earlier this morning. Is tapering bullish or bearish for treasuries? This is what Shahid Ladha of BNP Paribas had to say on that. Take a listen.
Ultimately, it's bearish for treasuries, but a lot less bearish and a lot less messy, if you like, than it was in 2013. Financial conditions remain accommodative, and we haven't seen really major signs of tantrum or broad risk off, and neither do we expect that this year. So a relatively tantrumless taper is what we're calling for here.
Now, Cora, I want to come to you on that very question. If we are moving closer towards tapering, is it bullish or bearish treasuries? Because many people are looking at this price action at the moment and concluding it might be bullish.
So I think it's all about the Fed and how they communicate tapering, right? They want to be patient. They mentioned that in the minutes. They want to take time for growth to be strong enough for the market to feel good about growth actually supporting corporations, growth supporting the market. So I think it's all about the timing and not being too aggressive in the way that the timing actually plays out. But this does kind of open up a window, if the Fed is anticipating tapering or announcing tapering sooner because of inflation, then that could cause a kind of a bearish result if we see an inflation pop and not necessarily the growth pop.
Jerome Schneider, what would your response be to that question?
Yeah, ultimately, we think that there's a general sequence here. We are of the bias that it is a steepening trend propelled by that higher growth over that medium term. But I do think that there is going to be, some potential. And as you highlighted here, it all comes down to inflation expectations. And if those expectations are met and quenched with a more responsive Fed, because of the fact that that substantial majority does overwhelm and actually pushes tapering front into the spotlight, then you can actually see a bit of a rally into the back end of the curve. But ultimately, over time, this is a growth story, a recovery story, and that will lead to a bias to be more higher rates in the long run, that steepening trend in that regard.
Jerome, you touched on something really important, so allow me to return to it. I did this exercise yesterday with Bob Michael of JP Morgan Asset Management, and we just looked at the forecasts for this year, for next year, and the year after. The consensus view on a Bloomberg terminal for economic growth in America, real GDP, as follows. Median forecast, 6.6% for 21, down to 4.1% for 22, to 2.3% for 23. And I asked the basic question, what's important here? The deceleration or the cumulative gains that you'll get from these kind of levels? But you alluded to something different. You think that maybe we're repricing growth lower than those numbers that I've just read out, 6 to 4 to 2.
That's probably true. And I think at PIMCO, we're slightly even under some of those numbers, especially with 2022. I would say the following, though, is that ultimately these numbers are significantly higher than where we've come from. It obviously does go hand in hand, more importantly, with the global recovery, which will happen. If we move from this desynchronized recovery to a more synchronized recovery globally, that probably gives us more healing power, more impetus to higher rates, not just in the U.S., but globally. And so 2022 has a lot of answers questions that need to be answered, quite honestly, in that regard. And so that will help sort of more quantify and put a square around where we're headed in that growth pattern. Ultimately, though, the story is about growth, and hand in hand, that goes with inflation. In the near term, inflation is really driven by the bottlenecks, how we're seeing the economy coming back online, both domestically and globally. And as those bottlenecks work themselves out, then we're going to see inflation get to a more normalized, more in focus aspect. So it's going to move. The dialogue is going to obviously move from inflation, and really in the near term, what's going to trigger the Fed front to taper, and more importantly, into a growth dynamic in 2022 and 2023, which is maybe perhaps going to elicit an actual monetary policy rate response at that point in time.
Noel, I wanted to give you a final word on this, and I know that we had some technical problems, so you may not have heard the original question. I'll repeat it for you. This deceleration we're expecting from growth this year into next and the year after, from 6.6 to 4.1 down to 2.3, How do you frame that as you look at this market? How important is that, the deceleration or the cumulative gains from those kind of numbers?
So we think about it as, you know, Q2 is kind of going to be mostly the peak of GDP, but Q3 is still going to be strong. And then as we see some deceleration, we think that that's going to be healthy. You know, we don't want the market to become too overheated. But for the fixed income market, we don't need, you know, extreme growth. We just need enough growth to keep the lights on at corporations and pay back the bills. So we think it's still a healthy market for credit here.
Noel Curran of Invesco alongside Jerome Schneider at PIMCO. Sticking with me, equity futures down 59, call it 60 points lower on the S&P 500. We are negative by 1.36%. Let's get you some movers at the market desk. Here's Katie Greifeld.
Hey, John. Well, it's rough out there this morning. Tech is joining the sell-off even as yields push lower. Apple is set to open lower after hitting a record Wednesday, and it's a similar story with Nvidia and Amazon. And you also have Tesla falling pre-market despite unveiling a cheaper Model Y in China. But if you thought that was bad, John, let's look at the banks because financials are getting hammered this morning even as the 10-year dips below 1.25%. And it's the long end that's leading the bond rally that's flattening the yield curve. And that's a difficult environment to make money in if you're a bank, and you're seeing that in shares today. And finally, John, let's look at the travel stocks because part of the reason sentiment is getting slammed here is due to Delta variant fears. That's hitting airlines and cruises before the bell, particularly Carnival Corp. And if this loss holds, it'll put Carnival on track for the worst week since September, John.
Katie, thank you. Much more from Katie Greifeld going into the opening bell in about 16 minutes' time. Coming up, politics and the pandemic. President Biden seeking bipartisan support for his spending plan as the Delta variant continues spreading across the globe. That's coming up next. And we'll get the market calls from Jerome Schneider of PIMCO and Noel Curran of Invesco. 16 minutes away, the cash open. We're down 60 odd points on the S&P 500 at 42.89, negative 1.4%. This is Bloomberg. Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
We're going to continue to have a strategy led by public health authorities, guided by Homeland Security, CDC, my department at the table, to reopen travel as quickly as we responsibly can.
There's been a lot of improvement in this pandemic, particularly here in the United States, but there has been no progress whatsoever on lifting some of these international restrictions. From New York City this morning, Good morning. I'm Jonathan Ferro. Counting it down to the opening bow with equity futures down by a little more than 1% throughout most of this morning, and Treasury yields breaking 125 at one point. Heading down to Washington, D.C. now to catch up with Bloomberg's Anne-Marie Jourdain, our Washington correspondent. Anne-Marie, walk me through on where on earth we are with the infrastructure talks in D.C.
Good morning, John. Well, we do have Congress out of session now, but what we are hearing, and Politico reported that potentially as soon as July 19th, we could see that bipartisan, the hard infrastructure, hit the Senate floor for debate and then potentially get passed. And then, of course, you have what the president was talking about yesterday, his third trip, we should note, in the past week or so to the Midwest. And this is really to drum up support for the softer infrastructure, the multi-trillion-dollar plan to expand education, childcare, Medicare, and all of that, which would include higher taxes. So it's a bit of a push-pull in terms of what the Democrats are working towards. The president, of course, wants to keep those Republican senators on side that he struck this infrastructure deal with, the hard one, but at the same time, making sure he's giving a nod to the progressives so that in tandem, they could work on the broader infrastructure, human infrastructure through reconciliation. That is going to be the harder one to push through, John, though, of course, because you have the Democrats really on both sides, and they're going to have to at some point come into the middle here.
Anne-Marie, you'd covered Brexit for the last 5 years. You're well aware that timelines and deadlines don't mean a lot. And I'm going to ask you a question with an answer that probably doesn't mean a lot at this point. What's the deadline? What's the timeline actually look like down in Washington?
Timelines in Washington similar to timelines when it comes to Brexit, and also as well as the European Union in general when you're looking at timelines. Well, as I said, they want to work on July 19th. Can they get something done then? That remains to be seen. I think the end goal timeline would be before, of course, next year, because 2022, John, it's going to be all about the midterms.
Anne-Marie Jourdain, down in Washington, D.C., a Washington correspondent. Anne-Marie, thank you. Still with us, I'm pleased to say, Invesco's Noel Coram, PIMCO's Jerome Schneider on this market. Jerome, I want to come to you first, sir. You mentioned the importance of maybe holding a little bit of cash going through the rest of this year. Can you walk me through the logic there?
Yeah, absolutely. I think it comes down to sort of volatility management. It comes down to managing uncertainty. And it comes down to, unless you have high conviction on where rates and risk are going, that you ultimately become more adverse. And I think what we're seeing is people starting to question growth outlook, people questioning the timing of the Fed and the tapering, and more importantly, the response of the market to that tapering. And so while the Fed is doing its best, and Jerome Powell and Rich Clarida are looking to make sure that we are well communicated in terms of that timing and not create any unexpected surprises. The reality is that volatility management is at the forefront of people's mind. So we've seen cash balances move higher. We all know that money market funds have $4.5 to $5 trillion sitting on the sideline. A lot of it's retail, a lot of it's corporate cash. We'll see the corporate cash come down over time. But ultimately, we had this giant amount of cash sitting on the sidelines. So what we have to think about is a more constructive way to manage our cash, effectively capitalizing on these cash allocations, not just thinking about putting them under your pillow as a defensive shock absorber, but actually how to extract a little bit of value, a little bit of income. It's not simply simply a story of active versus passive here. It's actually one where you can actually utilize it to pivot to more attractive opportunities as we've seen these recalibrations occur, as we see clearer forecasts come into focus. And over time, this ability for cash actually has a lot more value to people's portfolios than simply earning a few basis points in money market funds or slightly out the curve where you can earn more. It actually comes down to more tactical and rational decisions in terms of risk allocations. And that's fundamentally where we think cash comes into play in portfolios at this point in time, and not just for the next few weeks and months, but likely for the next few years.
Noel, your response to that?
Sure. I think I'm probably a little bit more bullish than that in the sense that, yes, we do. It's not the time to load up on risk here. We do think it makes sense to manage for volatility, of course. But we just don't think that the growth story, the positive story there has been fully played out. And we think the Fed's going to continue to communicate that they are patient. So as a result, we would expect credit assets to do well. Duration-linked assets, so investment grade, higher quality stuff, might suffer a little bit amidst the volatility. So it makes sense to also play in maybe some loans. But at the end of the day, we do think that growth is going to support credit assets here, and it does make sense to play in various asset classes.
Noel Coram from Invesco, thank you, alongside Jerome Schneider of PIMCO. Guys, good to catch up through the last 20 minutes or so on another fascinating summer morning. Just not the summer that many people expected in this bond market, with yields through 130 through so much of today. Coming up, the morning calls, and later, growth concerns punishing futures with nowhere to hide in this equity market through much of this morning. That conversation still ahead with John Hancock's Emily Rowland and Chris Harvey of Wells Fargo. From New York City this morning, good morning. About 7 minutes away from the opening bell this Thursday morning. 42.90 on the S&P. We're down around about 60 points. Settling down and settling in around negative 1.4%. We're down by 1.37%. This is Bloomberg.
G7 today they need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated! The world is possible!
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Five minutes away from the opening bell in New York City this morning. Good morning. We are lower. We're down by 1.37% on the S&P. The underperformance coming from the small caps. The Russell down by a little more than 2%. That's the price action. Here are the morning calls. First up, RBC Capital downgrading DR Horton to sector perform with a one-on-one price target. The analysts seeing limited upside due to the weakening near-term orders and pricing power. That stock's down by 3.4%. Your second call from Goldman, downgrading Charles Schwab to neutral with a $76 price target. The analyst expecting retail trading volumes to slow down. We're negative 4% there. And your third and final call from Barclays, downgrading Freeport-McMoran to underweight, $29 price target. The analyst highlighting elevated multiples and nearly record high margins. That stock is negative 5%. Up next, nowhere to hide in this equity market. Investors rotating into the safety of treasuries. That conversation up next with John Hancock's Emily Rowland and Chris Harvey of Wells Fargo. From New York City this morning, good morning. Equities heading lower going into the cash open. Your opening bell is next. This is Bloomberg.
valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
24 seconds away from the opening bout. This has been a choppy morning so far this Thursday morning. Good morning. And here's the state of play in the equity market. Equity futures down 59. We're off by 1.35% on the S&P 500, 42.91. The other performance on the Russell, we're negative 2% there. And the NASDAQ off by 1.4. That's the opening bout. Switch up the board and get to the bond market. And here's the curious part of the price action so far this morning. Treasury yields have had a tidy move off the lows. We had a break at 125 a little bit earlier this morning. Now we're at 129.45. We're down by 2 basis points, but despite that, equities are still near session lows, even with yields moving off the lows. So that correlation, at least over the last couple of hours, and make of that what you will, not as tight as you might expect. In the FX market, a euro's firm and a dollar's weaker. Euro-dollar 118.56, up 0.6%, and crude down negative 0.4%, a break of 72 at 71.93. That's the cross-asset price action this Thursday at the market desk with your movers. Back with us, here's Katie Greifeld.
Well, John, even with yields bouncing back a little bit, no sector spared today. Tech is stumbling out of the gate. It's falling alongside energy shares. You have both Tesla and other shares down, and the wheels are falling off the rails for meme stocks, with AMC down for a 5th day. Meanwhile, the reflation trade continues to deflate. Energy and industrial names selling off early. Occidental still up over 60% this year, but it's down for a 4th day today. Retail also coming under pressures, with Macy's down over 3% at this moment. And John, the froth is even starting to exit the housing market. Take a look at the iShares Real Estate ETF. It's one of the biggest realty funds, and it's lost money for 5 straight days. That's after its best month of inflows ever in June, John.
Katie Greifeld on the latest move. Some important stats and some of the flows there worth watching too. The S&P 500 opening lower then, down by a little more than 1%, negative 1.16% on the S&P. Here's your breakdown. Pretty broad-based declines across all industry groups. The industrials down by 1.46%. Information technology down by 1.44%. We've had a catch-up with a fantastic series of guests over the last couple of days on what's happening in this market. Goldman's Abby Joseph Cohen warning the backdrop for equities leaves very little room for error. Take a listen.
When you're at fair value, there's no margin for error. If there are disappointments, be it on interest rates, the disappointment on OPEC, for example, over the last few days, that's where you start to see a big increase in volatility within the market itself.
And we have that volatility this morning, and with us to work through it is John Hancock's Emily Rowland and Chris Harvey of Wells Fargo. Emily, let's start with you. Your reaction to the price action over the last week or so?
Well, John, I woke up this morning and I thought, finally, bonds and stocks are acting like they're supposed to. They're acting uncorrelated. And of course, that message is changing a little bit this morning. We're not totally surprised, frankly, by the rally that we've seen in fixed income. We saw a huge move to start the year in the 10-year Treasury, up about 80 basis points in just 3 months. And coming into the second quarter, we heard just about everybody positioning for a steeper yield curve. You turn on John Farrow in the open, and every strategist that came on was talking about a steeper yield curve. And sometimes as everybody sort of gets to one end of the boat, you can see the ship start to tip over a little bit. And what we think is happening here is not that growth is falling off a cliff, but that we're moving away from this peak growth environment. I almost hate to say it because I know there's been a lot of ink spilled on peak growth and peak inflation, but I think it's important as we move to this level of more moderate economic growth. And when we think about, what are the catalysts to cause a further backup in Treasury yields, there really aren't a lot. We're coming off seeing the biggest economic surprises or upside surprises to economic data that we'll probably ever see again. And again, not a terrible message here, but we do expect a growth in inflation to return to more moderate levels, which is, again, causing this bid for Treasuries.
Emily, I'd like to turn back to you in a moment on the position squeeze. We'll come back to that in a second, so stay close. Chris Harvey, I want your initial thoughts on your reaction over the last week.
So I thought equities held up much better than they should have. And
with the drop in rates, we are seeing futures down. We're seeing the market lower, and that's to be expected. Themselves is something's broken. It's not recover. Let's take some risk off the table. Let's reevaluate. We've had a great run, and we're going to trade these things down for now. We can figure out what's going on. But back to the point about why treasuries are down. Recently, it seems to be more about technicals than anything else. You have a lack of liquidity. You have some weak hands, and you have during the summer months, you would expect.
Chris, I'm going to jump in. There's just a little bit of a problem with your line, sir. Chris Harvey there of Wells is joining us. We're going to re-establish that connection, Chris. I'm going to check back in with Emmeline, who I'm pretty sure does have a clean line for us to have a conversation on. Emily, you mentioned positioning. And I think when it comes to positioning, this is really, really important. When you do get that move from one side of the boat, and forgive me for having guests that are so consensus sometime, and they all start to move to the other side of the boat, you get this big position squeeze that becomes really self-fulfilling. And then the narrative comes after the price move, and people come up with a fundamental story. And there's a risk here, of course, Emily, that people take a technical move that is really fueled by positioning, build a narrative, and extrapolate that out all the way through the cycle. Do you think that's a risk right now?
I do, and sorry, John, that was not a knock on you. You have phenomenal guests all the time, and I'm a big fan of your show, as well as being a guest here. But I do think so, and if you think about that positioning that was taking place coming into the second quarter, and we saw it with value as well, as investors started to tip the boat, moving from growth into value, it really was coming at a time as we were just heading into this peak growth environment. We look at areas like PMIs that were peaked in May. We look at the leading economic indicators, as you know, that are still at a very elevated level, but year over year growth certainly here is decelerating. So again, not a terrible message, but what it means is there's important changes happening under the surface that require a change in positioning. What we've been doing is trimming cyclicality, ex-industrials. We do still like industrials. It has those quality elements that we're looking for now as we head into the mid-cycle environment where fundamentals become more important, but we are embracing quality growth, which is an area of the market, as you know, that we have been overweight for some time. We want to think about the importance of fundamentals here. Looking back over the last 12 months, we think of it almost like a kid's swim meet. My kids just started their swim season yesterday, actually. They're not very good. And so the way I think about this is that everybody got a ribbon over the last 12 months. Everything was up, regardless of industry standing, regardless of the ability to outperform the competition. Over the next 12 months, it's like the Olympics, right? Things get a lot harder. The comps get harder from an earnings perspective. Input costs may go up. We may even get higher taxes. Margin pressure is going to start to eat away at some companies' profitability. So we want to hear focus on quality, areas that have good return on equity, great margins, ability to grow organically as we transition into this more sort of normal economic backdrop.
What you've mentioned then, and I think what you're alluding to, is whether you just get a participation trophy for being invested in this market or not. And as a side note, I wish your kids the best of luck at the next swim meet. When you look at a chart on the S&P 500, Emily, it's from the bottom left to the top right, and it's a straight line. And that chart is unlike what I see in treasuries. It's unlike what I see in nominals, break-evens, real yields, where it's been really choppy. And beneath that has talked to that story that you've just mentioned, growth, value, cyclicals, big tech banks, all of that good stuff. Yet for a lot of people, I just wonder, Emily, whether it really can just continue to be this simple, that we don't have to have these nuanced conversations about the bond market and active management. Why can't we just stay passive? It's worked so well over the last 12 months, despite, as you point out, a lot of people on this program saying continuously, it's about active management this year, it's about active management this year, but being lazy's been okay. You've done well this year.
It sure has. I mean, not going to swim team practice has really had no consequences over the last year, but what we're going to see emerge as we head into the next year is that there is going to be a differentiation between the winners and losers from a stock perspective, from a sector perspective, and we think that fundamentals are going to come back into the spotlight. As far as equity market volatility goes, obviously we haven't seen any. Usually what happens in year two of a new bull market, which started, by the way, in the beginning of Q2, is that you do see volatility. In fact, if you look at the example post the global financial crisis, in year two of that new bull market, we actually saw a significant correction to kick it off of about 15%.
We haven't seen that yet. So we're not used to this type of volatility. We do expect that it could continue to present itself as investors digest some of these macro risks that we're starting to see. But ultimately, we do think that it is an opportunity to add to equities. The fundamentals are there. Earnings estimates continue to move higher from a next 12-month earnings standpoint here in the U.S. We want to own it, and we do prefer the U.S. over other markets internationally as well.
I'm going to turn to that U.S. versus international story in just a moment. Just a final question in this segment. I caught up with Morgan Stanley earlier this morning. And Emily, I think, as you know, if you're familiar with their research, they're always talking about where we are in the cycle. And the question I'm about to ask is slightly provocative. It's just to get us thinking a little bit more. You mentioned the second year of a bull market. I just wonder, is this really the second year of a bull market or just a continuation of the last one going into the pandemic? Was just the pandemic last year a bit of an aberration? And the reason I ask that question is whether we're waking up just sort of mid-cycle already, or mid to late cycle and just a continuation of where we were going into the pandemic. What's the best way of thinking about this?
John, the way that we're thinking about this is that this cycle is moving at warp speed. You don't see things happen as fast as this in previous cycles. It takes, the Fed's not so quickly thinking about raising rates. You're not so quickly seeing that flash in the pan performance of more cyclical areas of the market. You're not seeing kind of toppy things happen like the stretch sentiment we're seeing in areas like cryptocurrency, areas like the meme stocks. That typically happens at the end of an economic cycle. So that makes positioning incredibly hard for multi-asset investors right now. You want to have enough risk in a portfolio to participate as the markets continue to climb here, but you also want to be really thoughtful about how you're positioning underneath the surface, which leads to some of the conversations that we've been having around quality.
Emily Rowland of John Hancock is going to stick with us. We're going to have this conversation about the international side of this story, with the ECB making a little bit of a move around its goals earlier this morning. I believe we're going to get Chris Harvey of Wells Fargo on the phone with us as well, so we can have a real conversation with him too. Your equity market's pulling back a little bit. Here's Katie Greifeld with more. Hey, Katie.
Hey, John. Well, there's still plenty of red on the screen, even for your green energy stocks. You have Plug Power and Fuel Cell both falling this morning, down about 2%. EV maker Nikola is also falling, though it's paring losses a little bit now. But for Chinese tech, the pain keeps coming. Didi falling for a fourth day. It's now down over 20% since its IPO last week. Baidu and Alibaba also getting crunched this morning as China broadly signals a crackdown on international listings. And John, if you were trying to hedge with crypto, it's not working out too well. Bitcoin is down about 6% today. That's putting pressure on your crypto-linked stocks, from miners to MicroStrategy. Though, John, I will say those MicroStrategy junk bonds still slightly above par.
Unbelievable. Katie, good to catch up. Thank you. Coming up, the ECB raising its inflation targets, revamping its strategy in hopes of bolstering the economy. That conversation is next. This is Bloomberg.
Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Freedom delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
The previous double key formulation of below but close to 2%, which was widely seen as too elaborate and occasionally giving rise to misperceptions about the Governing Council's aspirations. The new formulation removes any possible ambiguity and resolutely conveys that 2% is not a ceiling.
The ECB raising their inflation target to 2% and allowing room for somewhat of an overshoot if they can engineer one. The strategy revamp giving officials ground to keep monetary policy accommodative perhaps for even longer. Out of London, my colleague and good friend Bloomberg's Guy Johnson, who's lived this for a while alongside me. Guy, this feels like a tweet. Feels like Federal Reserve light and maybe not a major change over at the ECB.
Yeah, this feels like a paler version, doesn't it, of the Fed's AIT. This was billed, John, as the biggest strategy review since 2003. I think there may have been some hyperbole in there, because actually, as you say, what we've ended up with here is a little bit of a tweak. What we're going from is effectively an asymmetric target to a symmetric target. I think we were probably already there. Basically, what we had before was close to 2%. Now we are basically seeing inflation above and below as equally bad or good, depending on your point of view. There is a tweak which I think is probably more useful, which is the medium-term aspect to this. It's 2% over the medium term, so that allows the allows the ECB, getting mixed up there, to essentially look through any transitory inflation spike that we may end up getting and not make the mistake that Trichet did. And I think probably the ECB, again, was already there because we've learnt this mistake from the past. So, John, yeah, I think you're right. We are basically tweaking policy here. I see the euro is higher. I think a lot of people are struggling with that. The chat from the desk seems to be that people are selling into euro strength at the moment. I think over the longer term, this will probably just give the doves a little bit more ammunition in terms of keeping policy looser for longer.
Clips the wings of the hawks over at the ECB and does the bias maybe of the Trichet years as well. Guy, looking forward to the coverage at the top of the hour. That is coming in about 20 minutes' time as Guy leads you through the European close and the rest of the market day stateside. Yields are lower in the United States, a break of 130, a break of 125 a little bit earlier. The equity market is lower as well. And there's this real conversation, US versus the rest of the world, international, that cyclical factor, deep value out of Europe. Where do you want to be now? John Cangot's Emily Rowland is still with us. Emily, let's go there, just briefly. Europe, the rest of the world versus the US. What's the framework now?
We prefer the US, and to tie the conversation about the ECB into the mix here, you know, what we're seeing is that this sort of persistent low inflation, low growth backdrop in Europe, it's going to be pretty hard for the ECB to get out of that. And the fact that we're going to continue to have negative rates, in our view, overseas is a big issue for European financials. And right now, that's not really being priced in. We actually saw European banks do pretty well this year on the back of that risk-taking rally we've talked about where fundamentals haven't been a big consideration for investors. So we see continued pressure on the European banks here as we move into the back half of the year and into 2022. And that's one key reason for our preference for the U.S. Now, financials from a sector composition standpoint are the biggest piece when you add the MSCI EFA index. When you invest in the U.S., of course, you're getting a huge overweight to areas like technology, which are parts of the market that we favor for that quality element as we move into mid-cycle.
Emily, always fantastic. I just wanted a final thought there on Europe versus the rest of the world and the United States. Emily Rowland there of John Hancock, thank you. And best of luck again to the kids in the swim meet. Chris Harvey of Wells Fargo on the phone. A problem with the visuals. We can get him on the phone to hear his voice, though. Chris, I wanted your thoughts on the equity market, and we lost you about 15 minutes ago, so let's start there. The US, you're at 38.50 year end. We're breaking down a little bit, still well north of your price target. What's happening?
So what I think is happening is, as you see, rates are going down. Investors are going to shoot first, ask questions later. They're going to think something's broken. Really, nothing's broken at this point in time, but we need some sort of healthy pullback, and I'm expecting in around a 5% pullback. If you look at what's driving the rates market right now, it's more technicals, lack of supply, weak hands, a forced buyer, and that's not going to change anytime soon. We haven't hit technical resistance on the 10-year, and so things will probably be a little bit sloppy in the short term. Longer term, what we've been saying to a lot of clients is we think the amplitude of growth isn't as high as we expected due to supply constraints, whether it's labor or inventory, but the duration of this is going to be a lot longer. So we continue to favor a lot of cyclical sectors, cyclical opportunities, but more specifically what we want to do is we want to have companies, we want to focus on companies that buy back share. We think that's a very good risk reward. We think they can take advantage of the low rates, and what that also does is in a very difficult tape, it helps you to the downside. And many of these companies do have what we think are favorable earnings prospects. So that's where we want to be, and those are our quick thoughts on the equity market.
Well, Chris, just briefly, if I can respond, what's the balance of risk around your price target now, year end? Do you think there's some upside risk now? Would you appreciate that? Acknowledge it.
Yeah. Listen, we've been too conservative. Where we've been wrong, where we've been too conservative is the uber cap stocks, the big cap stocks, the growth stocks have performed better than we thought. What we thought is you were going to get double-digit returns from small caps, from cyclicals, from financials, and that's been right. We've just been way too conservative on your growth and your uber cap, and they perform better than we would expect, and that's really the main story.
Chris, good to catch up, and I'm sorry this was so short. If my team can reach out to your team, hopefully we can put another day in the diary and have a longer conversation. Chris Harvey there of Wells Fargo, always transparent, honest about how he's thinking about this market, and brutally honest about his own price targets sometimes too. About 21 minutes into the session, clear underperformance in the small caps. Biggest decline on the Russell since May 12th, the middle of May. That was actually when break-evens peaked in the United States in the Treasury market. With your sector price action, here's our stocks editor, Dave Wilson.
Thanks, John. We actually have an industry group that's higher at the moment among the 11 main ones in the S&P 500. Utilities are actually up 0.1% after being lower earlier on, but it's really the more economically sensitive areas of the market leading the way down, whether you're talking about raw material producers, that consumer discretionary category where you find retailers and automakers and home builders, also financial stocks, industrial companies, even technology kind of hurting things at this point. Put all those groups together and, you understand why the S&P 500 is down more than 1% at the moment. One group you don't see in that mix specifically, though, is travel. I mean, we know that at this point there's a possibility that spectators won't get to see the Olympics at all, and who knows in terms of any easing of travel restrictions tied to the coronavirus. But there is this thing called the Blue Star Travel and Vacation Index. It's fallen every day this week, so 3 days in a row. That's actually the longest streak in a month and a half. And 52 stocks in there. Every one of them is down except Virgin Galactic, which plans that test flight over the weekend to bring founder Richard Branson and others into space. So it's really kind of a washout for the travel stocks.
David's a watch out through much of this morning as well for the broader market. Dave Wilson on this equity market. Coming up, the market moving events you need to be watching. We'll bring you the trading diary as we work our way into the weekend. One more day after this one. We're almost there. From New York, this is Bloomberg. 25 minutes into the session, here is the price action. The S&P 500, just a little north of 4,300. Incidentally, as we've repeated a million times on this program, there's your median year-end forecast on Wall Street. We're negative 1.2% with some clear underperformance from the small caps. That's the price action. Here's the trading diary. What you need to be watching through the week. President Biden speaking at 1:45 this afternoon. Friday, Secretary Yellen joining other finance ministers and central bankers in Venice for the G20 summit. The bank's kicking off earnings season next week. US CPI numbers out on Tuesday. And finally, Fed Chair Jay Powell testifying on Capitol Hill on Wednesday. From New York City, what a morning so far. And what a summer already this has been. It is not the quiet summer you were looking for. Keep saying that. This was the countdown to the open. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.